Welcome to Day 2 of Small Business Finance Basics, QuickBooks and Beyond with Ken Boyd right here on Creative Live. This is Chris Jennings.
This is Evelyn Danford, also known as Evie.
That's right. And we're going to be your hosts for the remainder of this course. We came into this yesterday, Chris and myself did, with a lot to learn, I'd say, in terms of business finance, QuickBooks, just accounting in general for a business. And I feel way ahead of the game compared to yesterday already. How about you, Chris?
Yeah, a lot of the terminology that Ken went over helped me a lot. They were words that I had heard before but didn't really have a firm grasp on. Things like vendor and invoice and PO, all of these things that he actually illustrated in the interface step by step in QuickBooks. So that helped me a lot.
The clarification, I completely agree. The clarification of words that I kind of thought I knew and then realized, well, actually, if I had to define it, I probably wouldn't have been able to do it until yesterday.
Yeah.
Now I can.
He cleared up a lot of it for us. So and that was just day one. We still have 2 more days to go.
We do, and we're very excited to get started. But before we do, we are going to do about 5 or 10 minutes of pre-show just to test our audio and video levels, make sure you can see us and hear us for all of you out there on the internet joining in. So be sure to jump in there and let us know that everything's working for you.
Yeah, and I'm going to be jumping into the chat with you guys as well and chatting throughout the next 2 days. So jump in there, tell us where you're from, and we'll be chatting over the next 2 days. But we also do have some people here in our studio audience, and you may have seen them yesterday. You may be wondering to yourself, how can I be one of those people who comes to the studio to ask questions in person? It's very simple. We have a way for you to do it. If you are interested, you can go to creativelive.com/front-row. And that's going to have all the information you need to become a studio audience member here in San Francisco as well as in Seattle. So you can go check that out if you want to be one of these lucky people in here.
It is quite the experience to be in here in Creative Live as a student. And we, time and time again, will talk to students, and it's just, it's incredible to be able to participate via the chat rooms, but even more of an experience to be able to be right here in the front row.
It is wonderful. So for those of you who missed out yesterday, we are going to go through and have everyone here in the studio audience just remind everybody who they are and where they're from. Also, one thing, as we're doing this, you may be hearing some construction noises. In this building, we do have some people doing some drilling and construction, so don't be alarmed if you hear any of that. The broadcast will continue.
That's right. That's right. We have neighbors, and we all have to share the space.
Yes, exactly. So don't mind those noises, but we are going to introduce our in-studio audience here. So why don't you guys just remind everyone your name and quickly where you're from, and we'll go through from right over here.
Hi, I'm Candace Betty from Huntington Beach. I wanted to make a quick comment on something I appreciated yesterday. Was Ken mentioned cash versus accrual basis, and I've always operated on a cash basis, and I really enjoyed the explanation of why he said to do the accrual basis, really matching your expenses with your income, and that really made a lot of sense for me, so thanks, Ken.
Great.
Thank you.
Thank you.
My name is Josh. I'm from San Francisco, and I'm hoping QuickBooks can help me manage some rental properties.
Terrific.
Thanks.
Thank you.
Hi, my name is Jackie O, and I live in San Francisco, and I was hoping to get more comfortable with QuickBooks, and that's happening.
Terrific.
Hi, I'm Christine Chagru, and I live in San Francisco, and I'm new to QuickBooks and enjoying getting to know it more.
Amazing. Thank you.
Hi, I'm Renee Hopkins. I'm from Sacramento, and enjoying the information from Ken, especially about the operations manual, because I can see the value of having that.
Absolutely, absolutely. I think a lot of our audience in the chat rooms as well felt the same way.
Yeah, we had a lot of people in the chat rooms yesterday. Quick shout out to some people who were joining us yesterday.
Yeah.
The international audience from all over the world. We had Chrysanthemum in Ontario, Canada, Mark in Boston, Catherine Ivanovich in nearby Oakland, California, and Dick Horner was joining us all the way from Germany. So thanks for everybody joining in yesterday. And some of those same people I see already coming into the chat rooms today. So we look forward to another day of chatting with everyone from around the world.
It's really cool that we have a broad audience coming from all over the world. It's very exciting for us here at Creative Live. And those of us at Creative Live, we're a little spread out as well. We have some of our Creative Live favorites are in Seattle, and some of us are here in San Francisco. Today, we're fortunate enough to have one of our Seattle faves right here in San Francisco with us. So we thought we'd bring her up here and introduce Celeste to you guys. Celeste has been around Creative Live for 3.5 years or more, I believe. Celeste, why don't you come on up here?
Celeste. Step right up.
Right here in the center. I didn't want to tell everybody who you are at Creative Live just yet. I thought I would let you introduce yourself and maybe share with everybody who you were before you found Creative Live.
I attended the Vancouver Film School in Canada and originally wanted to be a traveling documentarian and moved to Seattle and started getting involved in documentaries, did a lot of music videos, a lot of corporate videos for Microsoft, and discovered that traveling documentary wasn't for me. Traveling was, but the working and traveling thing, if you've ever done it, is a lot less fun. So started getting into producing, really enjoyed that, and started doing a lot of production managing, producing around Seattle, and eventually stumbled upon Creative Live. A friend of mine that I went to film school with is Chase Jarvis's editor. And so he connected the two of us, and back then it was just this small little adorable startup in a tiny little room in the back of a art studio in Seattle, and it was love at first sight. I met him, and it was just such a great group. There was, I don't know, maybe 5 or 6 of them then.
Wow.
Ken was there, Susan was there, and that was it. Just the gratitude that I received from the crew for having a producer. I don't think they've really had one before me. Was kind of overwhelming. So it was easy to come back when your work is appreciated.
Yes, absolutely. Producers are important. In case anyone isn't aware, we need our producers.
Yeah. So you have been at Creative Live for a while now. I'm sure you've seen a lot of things. You have a lot of stories. You have any particular story that you'd love to share with everyone that kind of gives some insight on what it's like to work in this environment?
Yes, I've got a lot. Which one? What really blew me away when I started working with here was the power of the audience. Especially when we first started, we didn't have a lot of money for the budgets. They were pretty small, and I was the only producer. I couldn't divvy out work and to source props and all that. I mean, it was kind of a one-man or two-man show. So when we had these big photographers coming to us, Zach Arias and Lindsay Adler, and we had Gail Tattersall, all these like great names coming to us wanting these incredible models and all these props and these huge set design ideas. And I'm like, oh my gosh, how am I going to do this with nothing? And I remember Craig Swanson, the founder, would say, let's just talk to our audience. Let's see if they'll bring it to us. So we've gotten this fantastic habit of sourcing all of our props from our audience. We would just get on Twitter or get on Facebook and say, hey, our producers are looking for vintage luggage or vintage typewriter or this type of couch. And we would have audience members from all over Washington, not just Seattle, drive hours to drop off props and just kind of hang out while we used it. And they'd get to meet the instructor, and they left super happy. We got free props. And that would happen all the time. It was just amazing how people would just come out of the woodwork to help us.
That's incredible. Cool. That's incredible. And I think that we still kind of represent that here in a way. Maybe represent isn't the right word, but I feel like our audience has so much gratitude towards us, and we have even more gratitude towards them. We're just it's a big love fest here.
It is. We really wouldn't be anywhere. We started on Twitter. We didn't have marketing. We didn't have anything. The audience spread the word about Creative Live. And that was it. We didn't have a marketing team. So it really was formed from the people on Twitter. And they've saved us. This audience has come through for us time and time again. I was telling you guys before the show about a fantastic story about. Actually, I'll tell you a different one. We went our first remote shoot. We went out of the studio, which is a very big deal for us. We were on location at this big, beautiful house, and we were very nervous because we'd never done this before. And the internet crashed within the first 10 minutes of shooting. Like the internet just went away. There was no way to broadcast live. And we were freaking out, of course, and we got on Twitter to Comcast because they weren't answering our calls. They were just, it's out and there's nothing we can do about it. And we're like, yes, you will. So we had all of our audience start tweeting Comcast, telling them to fix the problem. We had someone from Comcast call us, come out and figure it out, and we were back up within a half an hour or so.
So we owe you guys big thanks.
Thank you.
Yes, thank you, all of you. There's a lot of fun that happens both behind the scenes and right in front of the camera here at Creative Live. And I know you've been around I've actually witnessed some really fun moments.
You have.
Any of your favorites that you'd like to share?
Fun moments in front of the camera.
Front or behind, it's your pick.
we have, oh gosh.
I personally have seen Celeste swing dance with an instructor.
I knew that's what you were getting at. I wasn't going to say it.
It's one of my favorite Creative Live moments.
I got paired with an instructor, and I'm a swing dancer, Lindy Hop to be precise. And as when he came on set, he was wearing this zoot suit the first time I met him, and I was like, oh you dance, don't you? And sure enough, it was not just swing dancing, but the same type of dancing I did. So we would have our meetings here in this area. We had a wooden floor then. And I would come out and talk about what we were going to do in the next segment. Yeah. And the guys here are amazing and would just play swing dancing music over the breaks. And so, I love this song. So as we're sitting here talking about what we're going to do next as we're dancing, and that's how we had our meeting. It was really fun.
That's so indicative of Creative Live employees in general. I feel like everybody's very multi-talented.
We have a lot of fun during the breaks. A lot of good music gets played over these speakers.
Lots of dancing and singing. You probably see it over the cameras.
Yes.
We oftentimes will carry on with our shenanigans and be like, oh yeah, the camera's up there.
Well, that was, I know we're getting close to where we need to get into the show, but that was a successful moment, a very successful, fun moment. I think you have some embarrassing moments that have happened in Creative Live too.
Which one? Yes, I think probably it was sweet, but a little embarrassing. We had a posing workshop with an instructor named Bambi Cantrell, and they needed she wanted a mature woman that maybe didn't have as much definition here in, this thing. She wanted to be able to show how to pose that a more mature neck line that some women get. And I was like, how am I going to find? How do you ask for that in a model? And I was like, hey, Mom. So my mom was happy to do it. She came on, and she's a beautiful woman. So she came on and did it. And then Craig Swanson live. It's like, hey, I have an idea. We could get Celeste up there and pose with her mom. And of course, everyone's like, yes. So I come up. I have my IFB in, which is how we communicate with the booth. So I have all of my crew in my ear during this saying everything, poking so much fun at me while I'm sitting here posing with my mom, and I have my mic on, of course, too.
And your mom has no idea.
My mom has no idea. Just like apparently a very emotional moment for her. She's here at her daughter's work, and it's this big friend, and she leans over and she's like, "I'm so proud of you." I was like, "Thanks, Mom." It's like I'm here at work in front of everybody. It was,
and of course, I'm sure the guys had
they had a heyday. They had a heyday with it.
Well, that's awesome. I didn't know that story, so that was just a pleasure to hear.
Mom. Love you.
Well, Celeste, thank you so much for coming on
Thanks
and talking
for bringing
to
me out here.
us.
Thank you, guys.
Always great to have you in the studio.
Thanks a lot, guys.
Well, I think we're just about ready to get started now, guys. So before we do, I'm just going to take you on a quick tutorial of how to watch free classes, how to ask questions in chat, and also how to purchase anytime access. Now, if you go over to the live page where you're watching today's broadcast, you'll notice that at the top of this page, or any page of the Creative Live website, you'll see a green Watch Now button. Now, you'll click on this Watch Now button in order to select which course you'd like to watch. What will happen is a drop-down menu will appear. You'll see a menu across the top of the page, and you'll simply choose the channel. We've got 5 channels up there, and each channel should have a course streaming at that time, and you'll simply select the course that you'd like to watch. In this case, Ken's course, of course. If you scroll down to the bottom of the page, this is where you can purchase anytime access by clicking on that green Buy button. Also at the bottom of the page, you might notice a green Chat Live with Class Participants button. Now you'll click on this button in order to chat with other class participants. It's also where you'll go to post questions that you'd like Chris and I to pass along to Ken. Now when you click on that button, a new window will appear with 3 tabs. Whichever tab you click on will be the chat room that you're in. The first chat room is the Creative Lounge. Now this is where you'll have all of your off-topic discussions. So any discussions that you'd like to have that aren't on topic for the course, you just want to get to know your community members a little bit better, you'll click in this room. Second room you might find is the Creative Live room. Now this is where you'll have any on-topic discussions. So anything that Ken's discussing at that time in the course, you'll talk about right here. And the third and final tab is the Creative Cues tab. This is where you'll post all of your questions for the instructor. Now we do ask that you only post questions here, that you don't answer questions or discuss questions here. If you want to do that, that's great. We just ask that you take it back over to the Creative Live tab. Also, you don't need to post questions more than once. We have a great chat moderator working behind the scenes. Alexa's been with us all day yesterday, and she'll be with us today. She's incredible. And she is keeping track of all of our questions and getting them to us. So once you post once, you don't need to post again. Now, this is Small Business Finance Basics, QuickBooks, and Beyond with Ken Boyd right here on Creative Live. If you're new to Creative Live and you're not sure exactly how we work, we basically do our best to reach as many people during the live broadcast as possible for free. However, if this is a course that you think you might want to own anytime access to, have at your fingertips whenever you'd like, you can also purchase the course for $149. However, if you purchase it right now during the live event, we also have it available for the live discounted price of just $99. Now, if you go over to the course page where you're watching today's broadcast, you'll also notice a green enroll button. Now, enrollment is free. It's very simple to do. You simply click on that green enroll button, and this will also enable you to have access to all of the bonus materials that come with enrollment. We've got some great bonus materials specifically in this course that we'll talk about a little bit later today, but this is definitely something you don't want to miss. Additionally, you can purchase anytime access to the course easily right here by clicking on the green buy button here as well. Now, if you scroll down from this page, you'll notice this is where you can find the bonus materials, all of the course bonus materials. This is both with enrollment and with purchase. You'll download them right here. And directly below that is where you'll find all of the course videos. Now, you can download the course videos in low resolution or HD, but additionally, you can simply stream them directly from our website by clicking that green watch button. Now, I think we're just about ready to get started. It's very excited that we're here on day 2. Our instructor, Ken Boyd, has over 29 years of experience in education, accounting, financial services. He's a former CPA and author of Cost Accounting for Dummies and co-author of Accounting All-in-One for Dummies, both of which are available if you have interest. They're available on Amazon. He is also the owner of St. Louis Test Prep and a small business owner himself. He also works professionally guiding other small business owners, giving them feedback and guidance so that they can reach their own business goals. He is a terrific instructor and a joy to be with here at Creative Live. Ken, why don't you come up here on stage?
Thank you. Thank you.
Thank you for being here for day 2. Great,
Thanks.
great. We had a great day yesterday, and I know we've got plenty to do today, so I'll just let you take it away.
Okay,
Thanks.
Thank you, everyone, and thank you, Internet. I was talking to my good friend Dave at my super cool hotel lobby today. I feel really super cool staying at the Clift Hotel in San Francisco. And one of the things we talked about is a lead-in to the next segment, which is forms of business ownership. And if you remember yesterday, I talked about a term, and we've also got a whiteboard that I think might help today. Who gets what? Trying not to turn away from the camera as I do this. There's a challenge that we're going to try to address in this segment, and the challenge is whether I'm starting a business from scratch, and some folks in the audience here are, or if I'm advancing and I'm considering collaborating with other people, I have to have a discussion about who gets what. Now I'm going to explain more about who gets what that means in a minute. So what we're going to give you today is a solution to that question, who gets what, how do I set up my business, and what are the factors that come into play when I set up my business. So if you look at the first slide, which I think is kind of a cool graphic, there's 3 forms of business ownership. How many of our folks here are sole proprietors? I think most of you are, right? For the most part. So a sole proprietor is you're working by yourself, you are the only employee, and basically everything flows through you, profit, loss, ownership. I'm going to touch on this just very generically. I know that I think Renee is either going into or has a partnership with your husband, right? So if a partnership by definition is 2 or more people. Now, there are partnerships that are very large that have thousands of partners. The big accounting firms, the biggest in the world, have thousands of partners. Law firms can have hundreds of partners. So a partnership by definition is 2 or more people. Okay? Now we're going to get into costs and benefits of being in a partnership. I had a discussion based on a comment that Jackie made yesterday about the last one on the right, which is corporation. And the fact that if you want to grow a large entity, if that's your goal, eventually you have to become a corporation, because corporations allow you to sell shares in your business, stock in your business, and it allows you to add on almost an unlimited number of owners, which allows you to raise almost an unlimited number of dollars of capital if you need it. Okay? So that's an overview of the 3. Now, word of caution, there are more complicated versions of this. There are LLCs, limited liability corporations. There are S corporations. There are variations on this. But for the purposes of this course, I'm going to limit it to those three. Okay? I'm going to limit it to those three. Sole proprietor. How many people have gone out to the Secretary of State and picked out a name for your business and gotten that registered? A lot of you have. Okay? So, your state, and by that I mean for your state. So I'm in Missouri. On the eastern side of the state, we pronounce it Missouri. In the middle of the state, they pronounce it Missouri, so you can always tell where people are from. And by the way, we call Diet Coke soda in St. Louis, but then when I went to college at Kansas, they called it pop, and I didn't know what anybody was talking about for a couple of weeks. Oh, that's soda. Soda, you guys call it pop. Okay. State of Missouri, Secretary of State's office. You go online, and there's a form to get a corporate formation done. So my business is actually, I have St. Louis Test Preparation, but it was actually originally registered as an old name that I don't use anymore. So I have a business that's called Old Name DBA St. Louis Test Prep. DBA means doing business as. So, if you want to change the name of your business after you've set it up for the Secretary of State's office, no problem. You can just register it as doing business as. Now, St. Louis Test Prep, I'm going to abbreviate. That's a fictitious name. That's a name I made up, which is fine. That's a fictitious name. The other nice thing is that even though I set up the company name as Old Business Incorporated, I can have multiple fictitious names under the same umbrella company that I set up at the state level. So I'm considering seriously starting a second kind of a business consulting business. So I would go out to the state, real easy to do, go on the site, and I would add another, what they call a fictitious name, and I'd have two names that are both DBA doing business as. Okay? That's how we would set it up. So you go to your Secretary of State's office. Taxation. This is one of the reasons that I wanted to use the flip chart. And I always teach taxation with buckets. So here's a bucket, and this is you, sole proprietor. I'm going to put sole P there. Think of that bucket as you, okay? Try to switch colors so you don't get tired of looking at the same color. In 8th grade, I had, what's his name? I can't think of his name, but he looked exactly like a young Dan Aykroyd, Mr. Van Brunt, in 8th grade, science class. And he had 3 boards, and he would write in white chalk, and he would fill up 3 green boards with white chalk. Isn't that hard to look at? I've always remembered it. It was horrible. You know, you look down at your paper and you look up and you're like, oh, I don't even know. Where is he? I have no idea. So I try to use different colors here. You have revenue or sales, and again, I use those terms interchangeably, coming into the bucket. Say it's $1,000. For a sole proprietorship, I have on the slide over here, it is a flow through to the owner. The profit and loss flows straight through. There's a hole in the bucket, and the profit, you got expenses in the bucket too. The profit goes straight to you personally. If I'm writing too low on the board here, if the producers could let me know. Is that okay? Can we get that? Yes? Great. So the money has flowed. Revenue came in to your business, the sole proprietor bucket. The profit came out the bottom and it went to you. Is everybody okay on that? The tax form that it ends up on is your 1040 tax form. Your 1040. Okay? Again, I don't want to get too taxy, but I do want to take this one more step. So everybody's got fills out a 1040, right? Okay. If you look at the first page, and this is needed to clear up some confusion. Because people ask me all the time, okay, well that concept makes sense, but I don't understand where it goes on my tax return. Very briefly, without getting too much into tax. Here's my 1040. There's a section on page 1 that says income. Say it's $500. Well, it says income. Many of you in the audience, and in fact, people that I've met this week, do freelance work, in addition to working either as a contract employee somewhere or working on their own, right? Lots of folks. That complicates your tax return. I was having a conversation at lunch with somebody from Creative Live yesterday about this issue. In fact, I'm going to do it on this other page because I think it's important enough, and I'm going to flip back to this one. Okay? Big problem for those of you in the audience. You've got income from multiple sources. This is very frustrating to Mrs. Boyd, who is on a plane on her way out here, so I better do well tomorrow because she's going to be here. What in the world is going on with your income? I've got to know, because in my business, I get book royalties, I get 1099s from, I may end up with 8 or 9 1099s this year. Okay? Not unusual for people in this audience. All right? So let's take a moment and talk about that because I think it's worth it. Without getting into a tax course, this is your 1040. It has a section that has income. Everybody, have you noticed it on page 1? That's where your W-2 goes, right? Say that's $20,000. I'm going to try to write a little more clearly, sorry. How many of you get 1099s? Right? 1099s go on that section. I'll say it's 2,000. One more. And this is the thing I'm trying to tie together because most of you watching this are in this boat. The profit from your business, you, sole proprietor, also goes on this line. And we total it up. Okay? It's a flow-through concept. The income flows through to your personal tax return. The profit from your business ends up on a line in the income section of your tax return, along with W-2 income if you have it, 1099 income if you have it, and you add it up at the bottom of page 1. Is that okay? Next issue, withholding. And again, I'm not going to go too far down this road, just enough for the audience. You need to make sure, and you need to go to an accountant and do this, that you are withholding dollars somehow to pay the taxes on the 1099 and the sole proprietorship. Okay? Do you have withholdings on your W-2? Sure. You don't have withholdings taken out of your 1099 or your business. So somehow, whether it's extra deposits, tax deposits, or money you set aside in a bank account. Somebody at Creative Live was telling me, I set the money aside in a bank account because I have some discipline to do that. And when the tax bills due, I write them a check. Most people do not have that discipline. This person did. What I do with my wife is we withhold a whole bunch on her W-2 to offset some of this impact that I bring in because we're filing a joint return. How many of you file a joint return, right? You may have a spouse who has the W-2 and you're doing this stuff down here and you're not withholding anything, and you need to have that conversation, and don't wait till the end of the year. Have the conversation with your accountant during the year. How do you do that? Call them up, give them some idea of where you're at, and say, can you estimate what my tax bill will be so I can get the withholding straightened out? Okay? Don't wait till the end of the year. Okay? I want to bring this chart up one more time and give you another analogy to help you with this. This is like a sieve or a sponge, and all the income and losses flow through the sponge. It's a sponge. Flows through, it doesn't keep anything. That okay? That's taxes for a sole proprietor. Taxes. I have LLC up there in the corner. As we get into this part of the course, I want to recommend that in addition to an accountant, that you talk to an attorney about the legal aspects of setting up your business formation. I'm going to make some general comments, but I'm not a lawyer and I don't play one on TV. So I'm not an attorney. A limited liability company is a method of having a sole proprietorship with some limitation on your liability. Here's what I mean. Generally, if you are a sole proprietor, you obviously have unlimited liability if there's a problem in your business. You have unlimited liability. So if you own a pizzeria and somebody slips on the floor and hurts themselves and sues you, and you're just a sole proprietor, in theory, you have unlimited liability for that situation. That's a problem. And again, I don't want to go down too far down the tax road, but you need to talk to an accountant because there are vehicles where you can be a sole proprietor and put limits on your liability. And I'm going to leave that to your accountant to do that. Okay? I have down here in the corner, the individual in the business may be considered the same person legally. Okay? Now, most of this audience are not in the types of professions where there's a lot of people, harming themselves with your product, so to speak. I used to work on it when I worked in auditing. Again, Ken can't keep a job. How many jobs has he had? It's ridiculous. Who has a garbage disposal? You ever looked at the name on the garbage disposal? Does anybody know what it says? It says incinerator. That's a product that is produced by a company in St. Louis, one of the few Fortune 500s we still have. You can imagine that if you produce a product like a garbage disposal, some people are going to get hurt. They also make huge ladders for fire trucks and emergency response vehicles. You can imagine people hurt themselves on ladders. Those are businesses where this legal liability is a big deal. For most of this audience, that's probably not the case, with this exception. I can imagine that there are situations where people in creative fields have committed to do something by a deadline and they don't meet the deadline and it somehow harms the client. I can kind of imagine that in terms of a legal liability issue, talk with an attorney. But I did want to mention that legal liability is real for a sole proprietor. Probably not a lot of legal liability for those people in this audience, I wouldn't imagine. Okay? Mm-hmm.
Oh, I just want to say that a lot of wedding photographers have formed LLCs just for that reason.
Great example. So a wedding photographer forms an LLC. I told you about my wedding photographer, Kim, who I think did some time in the joint, but had great pictures. But I did have the thought run through my mind. Now, here's how I think. I didn't think, gee, I'd really be upset if he screwed up the wedding pictures. What do you think I said to myself? Gee, my wife's going to be really upset if he screws up the wedding pictures. It was about her. So yes, there's some liability there on the line if you drop the ball on that, the client's harmed, so to speak. Again, that's a legal issue, and I'll leave that to an attorney, but that's a great example. Okay? So we talked about the sponge. We talked about the tax form. Have an attorney help you decide on what type of form you'd like to set up. Because it's sole proprietor, but there's some variations. Okay? I have a definition I'm going to read here. I do not have it in my slide deck, but I'm going to read this. I think it's worth it. Here's the definition of a sole proprietorship. A non-corporate business whose owners actively participate in the organization's management and are protected against personal liability from the, I got the wrong definition. I got partnership. I'm jumping ahead. Hang on, freeze that. Let me move on to partnership. I'm moving ahead. So that's legal, that's sole proprietorship. Any questions before I move on? Partnership. I mentioned by definition, 2 or more people. Big confusion on partnership. The percent that you own, that any partner owns, can be very different from the profit that you share. The percentage of ownership can be very different from the income that you share. I'll give you an example that I've used for a long time. The Texas Rangers are the baseball team, at least used to be a partnership. It's a partnership. George W. Bush, before he was governor of Texas, was the general partner of the Texas Rangers. Okay? Now, he had a very small percentage ownership. Very small percentage ownership. But he probably got a little bit more profit than the other partners because of who he was and his family. He was able to be the face of the organization and get attention and sell tickets, etc. So it's possible to have different percentage ownership and different percentage shares of profit depending on everybody's role. Depending on everybody's role. Okay? That's the first thing you should know about partnership. It's not static. It can be just about any form you want. And I always like to say that at the top. The way you structure that is through a partnership agreement. That's where you determine it. And that goes back to the whole who gets what discussion. Oftentimes what happens is you have an owner put in a lot of capital, and I'm going to do some examples later. An owner put in a lot of capital, and you have another partner who doesn't put in as much capital. You may have a situation where a partner who's active in the business gets a bigger share of the profit, where the silent partner, everybody heard that term, the silent partner, right? The silent partner gets less of the income but may have more ownership. And this structure can be however you want. I'll add another one. It's possible for a partner to get salary. Get a set payout from the partnership and other partners do not. That's possible. Okay? That's the beginning of partnership. Let's take it one more step. You have general partners and you have limited partners. General partners and limited partners. The general partner has unlimited liability, and I'm not going to write it all out because I think people are kind of getting the hang of what I'm saying. Unlimited liability not only for their actions, and this is critical, but for the actions of other partners as well. Okay? Limited partners' liability is limited to their investment in the partnership. A documentary, and I know a lot of you in the audience are documentary folks. Has anybody seen The Smartest Guys in the Room? The Enron documentary. It's a classic example of how badly things can go wrong in a partnership with general partners. And I highly recommend it. It was also a book written by a Wall Street Journal reporter. So this is the case where, in fact, at that time, my wife was working at Arthur Andersen, which was the company that was doing the Enron audit, and I was working at KPMG at the time. Without going into too much detail of what happened, essentially Arthur Andersen was accused of huge misconduct by not auditing the financial statements and disclosing things to investors. I'll leave it at that. You can watch the movie. Here's the point. General partnership. Thousands of general partners around the world doing accounting. There was a handful, less than 10, partners working on the Enron audit. What happened is that thousands of general partners were liable for the actions of just less than 10 people who royally messed up. I mean, in a big way. All of the general partners not only lost all of their investment, they were also, the firm was forced to go out, the partnership was forced to go out of business because they lost the ability to do audits of companies. They went out, it disappeared, it went away. Okay? Message for the audience here today. If you're going to be in partnership with somebody, you need to have a serious discussion about how you guys do business, taking on liability. You need to have that discussion because there is unlimited liability for people you are in partnership with, and I've seen this go bad many times. Oftentimes what happens, here's what happens. As I mentioned, you take Myers-Briggs, you're in a partner with somebody probably because they have a different skill set than you do, okay? I can think of two specific examples. So you're the creative person. You're bringing the value. You have the secret sauce. You're out there doing your thing, bringing in all the money. That's your role. You have a partner who's sort of the back office operations person who's handling the money and paying the bills and doing all the stuff that this course is about. And what happens in the two cases that I'm familiar with, you had one general partner who's not out selling the creative service, but in the home office, does not only makes a mistake that causes a lot of legal liability, but also doesn't handle the money correctly, okay? Without going into a lot of detail. The one partner you're in business with really screws up. What's the result? Both of you are equally liable for the actions of the other partner. And I'm particularly leery of situations where one person in the partnership is out doing the business, the value add, the secret sauce, and the other one is not. Okay? Now, they need each other, don't they? Those of you in this audience need, to one extent or another, somebody to help you with the accounting and the bookkeeping and stuff that's going on in this class. But you gotta know that person and be careful of the relationship that you set up. So that's my cautionary tale. Okay? Taxation, again, is the sponge. Now, the sponge, in this case, is a little more complicated. So I'm going to say P-ship for partnership. You go out, you do your creative work, you build people, money comes into the partnership. I'm going to say $20,000 comes in. The partnership has some expenses, sure. There's a hole in the bucket. And we're going to say a $5,000 5K profit comes out of the bucket. We'll further say there's two partners, Bob and Sue. Bob and Sue are going to have a partnership agreement that dictates who gets what, specifically how this profit is allocated. Let's say that Sue gets $3,000 based on the agreement. Let's say that Bob gets 40% to make the number easy, and Sue gets 60%. Bob gets $2,000 of the profit, Sue gets $3,000. Okay? Let me do that again. Partnership makes money. You're going out doing your thing. You're selling your services. You're collecting money. $20,000 comes in. Expenses in the bucket. $5,000 profit comes out. Based on your partnership agreement, you share the profit on this percentage basis. Now the question is, how does that impact your taxes? Same kind of thing. It's going to go on your personal 1040 tax return. It's going to come through on a document. I'm just going to say it because it's probably germane and people in this class are going to get them. It's called a K1 form, K1 for a partnership. You're going to add that income to your 1040 tax return. Okay, again, I'm only going down the tax road as far as I think I need to get what the audience needs. Okay? That's how a partnership works. When I used to do taxes, I would see people who had multiple K1s. Maybe they were in a partnership for their business and they were a partnership for real estate. I know Josh and I talked about real estate earlier. So you have people with multiple K1s. Now, you are going to have to pay an accountant if you have a partnership. This partnership will have its own tax return. I hate to say it, but you're going to have to pay an accountant to do this tax return because this course seems to be the Accountant Employment Act of 2014. Because I think we're getting accountants all kinds of business. Have an accountant do this tax return. I'd recommend an accountant do all your returns, but have an accountant do at least the partnership return. Okay, you got to incur some expense to do that. All right? Let me read the definition of partnership. This is from freedictionary.com. Just to give you, let's put a fine point on it. A legal contract, partnership agreement, entered into by two or more people, it's a partnership, who agree to furnish a part of the capital and labor. You guys are going to put stuff into the business for a business enterprise which each shares a fixed proportion of profit and losses. So that profit and loss percentage is going to be fixed. Okay? And again, that partnership agreement's very flexible. You guys can set this up however you want. Most states, it's very flexible. Very flexible. Okay? Talked about the sponge concept, talked about sharing, talked about general partner. Let me say this again. So general partner on my notes here, 100% liable for the debts and legal issues related to the business and the actions of each other. Now I've officially beaten it to death. The actions of each other. It's so important. Okay? One more thing on partnership before I move to corporations. You're going to put capital into the business. Okay? So for example, Christine's got the film business, she's got film equipment. She shows up with the partnership with film equipment. And the other partner, Joe, shows up with cash. So you're both putting stuff into the partnership agreement, into the partnership. Okay? I'm going to go over a little bit of how that accounting would work, just enough when I get through the 3 explanations of the corporate formation here. Okay. Yes, I'm sorry.
I would say the percentage of ownership can be different from the percentage of profit sharing.
Correct.
So how does that play with how you get taxed on how much of your profit? I mean, why would you have a different number for your percentage of ownership and a different number for your profit sharing?
I will answer that when I get to the actual transactions. I will answer that. I'm going to do corporations, then I'm going to go back and address that specifically. So hang on to that and remind me if I don't answer it, please. Okay. Anything else on partnership? Yes, sir.
We have a question here from Renata asking about, so are the business profits taxed twice, 1 at the partnership level and 2 at the personal level?
Oh, I'm so glad you asked that because I should have covered it. Your sole proprietorship and your partnership, it's only taxed once when it goes through your personal tax return. Once. Sole proprietorship and partnership. Okay? Which leads me to corporation. Legally, it's an entity separate and distinct from the owners. And we're going to find out that it kind of does its own tax return with profit and losses. So it's a separate, distinct entity. The owners are shareholders, and we learned yesterday that shareholder means you own equity. Shareholder. It's easier to raise capital. Kind of gives you street cred if you got a corporation to raise capital. Double taxation, top right-hand corner. Let's talk about that. This reminds me of using these buckets. I walked into a presentation in like 1986. A guy was going to present an investment product to a bunch of brokers, and he goes, and he was a former NHL hockey player that I remember. And he hurt himself, and now he was in financial services. And he said, normally my presentation takes 30 minutes, but I'm going to do it in 5 minutes. This is the bank, this is the box. And he went so fast, that's all I remember. There was a bank, there was a box. Any questions? It wasn't tremendously effective. I still kid about it with a friend of mine. How many years ago was that? 86? A long time ago. This is the bank, this is the box. 27 years ago. Still remember. I don't know what the bank or the box was. Didn't get that. Here is a corporation, Creative Inc. Bucket. Ken decides to stay in San Francisco and moves to LA and becomes a big star. He can't be a big star, but he can be a character actor because he's now middle-aged. He's not very good looking, so he becomes a character actor. Character actor. Sales, revenue comes into the bucket. Okay? Expenses go on. Now, here's what's different. There is not a hole in the bucket. Creative Inc. pays tax on the profit on their own tax return. Okay? So if there's a 10,000 10K profit, Creative Inc. Corporation pays tax on that profit. They create a tax return. They pay tax on the profit. They have a choice with the profit. They can keep the profit. And use it in the business. So if Christine goes out and does some business, and she has a corporation and she makes some money, but she needs to keep some of the profit to buy new film equipment, she keeps it. That's one choice. It's called retained earnings, and we're going to see the slide later on about that. Her other choice is she can pay a dividend to the shareholders. A dividend is a share of profit. Now, I had a big argument when I wrote one of the books, I don't remember which one, on this point. And I stuck by my point, and I don't really have my ego involved, but I thought I was right and insisted that we keep this in the book. You have to have profit to pay a dividend. If there's no profit, it's not a dividend. You're just returning people what they invested, okay? There must be a profit to pay a dividend, or else you're just returning people their investment dollars, okay? Last step, and I know we're getting kind of taxi and accounting-y here, but it's important that the audience needs to know this. We're going to say Tim is a shareholder. He owns stock. He gets a $100 dividend. I'm going to use D for dividend. That dividend to Tim is taxable again on Tim's tax return. Let me do that one more time. Corporation. Sales dollars come in. We incur expenses. We have a profit, $10,000. This corporation files a tax return and has tax rates and pays tax on the profit. After tax, what do we do with the profit? Well, we can keep it in the company, maybe to go out and buy more equipment if we have a photography business, or we pay what's called a dividend, which is a share of the profit. Tim's a shareholder. He gets a $100 dividend that is taxable to Tim. In fact, on that 1040 form that we all fill out, there's a line on page 1 for dividends and our income. So you just throw it on there. Okay? So, corporations are taxed twice. Partnerships and sole proprietors are taxed once. So there's good news, bad news with the corporation. Bad news is it is taxed twice. There's good news, though. Bad news on the left. Double taxation. Okay? I said the corporate net income or profit, using the terms interchangeably, goes on a corporate tax return, dividend paid to shareholders, bottom right, taxable to the individual. Okay? Bad news. Good news, easier to raise capital. Other good news, limited legal liability. Again, I'm not an attorney, nor do I play one on TV. Check with an attorney on this. Your liability generally is limited to the amount of money you invested in the company. So, unfortunately, when Enron went under, the maximum that shareholders lost was the shares that they owned in the company. What's so tragic about the story, if you watch it's one of the best documentaries I've ever seen. I'd like it if creative people watched it, because I'd like your opinion. One of the saddest moments is when the Enron employees are encouraging each other to buy more stock in their own company before the whole thing goes under. So not only did they lose their jobs, but the stock that they own went to zero. But that's the most you can lose. Top right-hand corner. This is so critical for the people in this audience. Caution, top right. To maintain legal separation, you must be careful to keep your business and personal transactions separate, hence the purpose of this course. All right? If you set up a corporation, for example, do not have one checking account for your personal and business expenses. What's the big deal, Ken? How hard can it be? Here's why it's a problem. If you have a legal issue, if somebody slips on the floor and hurts themselves and sues your corporation, and you say, I'm okay because my corporation is a separate legal entity. If you are mixing business and personal transactions, it may be possible for someone's attorney who is suing you to say, nah, they're really not separated. And if they're really not separated, your personal and business assets are at risk. So please, if you set up a corporation in particular, keep those transactions separate. Hence the purpose of this course. Questions on corporation? I'm glancing at my notes here.
Yeah, on the previous slide, I had a question.
Let me go back. Did I go back? No? Got to hit it again? There.
So isn't net income, isn't that the same as profit?
That's why I put a slash there. It looks like divide, I'm afraid, on the slide.
Oh, okay.
I'm sorry. Net
Okay.
income and profit mean the same thing. I should have put it in parentheses.
I see, okay.
Yes?
Got it.
Equally important under the partnership limited liability to keep your finances separate as well?
Yes, I'm glad you asked that. It's important under all three of these to keep your business and personal separate. However, the problem is that when you set up a corporation, people assume they're protected and they neglect to separate business from personal, which is what I've seen. Okay? Oh, okay, I'm going to go back because I'm not done yet. So let's talk about, in the time that remains, how we, in this segment, how we can tie what's going on with the partnership into what's going on from an accounting standpoint. Okay? What's going on in the partnership with what's going on in an accounting standpoint. And this is a good point to tie in that discussion that we had about debits and credits. And this is the reason that I have a whiteboard up here today, because I discovered when I was in the shower, where I get all my good ideas, this would be easier with a flip board. Somebody at Creative Live told me now there are Aqua Notes where you can write your notes in the shower. Amazing. Because I don't know about you, I'm not really awake until I'm in the shower. I have to budget for about 10 minutes of just generally stumbling around, just like trying to put I can't get my contacts in. So we have to go through that time period. Then we get in the shower and it's like, and things kind of boot up. So I thought this would be easier. So what I'm going to try to do is to take those debit and credit concepts and that T account concept and then use it to explain what's going on in an accounting standpoint with these three entities without losing everybody and having you run screaming out of the room. All right? This is why we needed the flip chart. Debits on the left, credits on the right. This is a T account. It was hard to show on a slide. It is a T account for cash. Okay? Name of the account at the top, cash. Debit left, credit right. Cash is an asset account. Okay? Sorry to turn my back to the camera, but I'm going to need to. Occasionally. This is Joe's capital account. Capital accounts are used for sole proprietors. Capital accounts are used for partnerships. Debit on the left, credit on the right. I'm going to put D and C. You will notice the debit is still on the left and credit is still on the right. Joe's capital account is an equity account. Equity. Let's say that Joe puts money into the business, $5,000. We debit cash to increase it $5,000. Here's where I tend to lose people. We credit Capital, $5,000. We increase equity accounts by crediting. That's actually an increase. Do it one more time. Debits on the left, credits on the right in both cases. I increase an asset account by debiting. I increase an equity account by crediting. Now, let me tie it to the equation that we had yesterday, and this is where I think I lost people. We had a formula in an earlier segment called assets equals liabilities plus equity. And I said that these amounts have to balance, right? We increased an asset account, $5,000, that's on the left. We increased an equity account, $5,000 on the right. The equation balances. And debits and credits are in balance. This is the point that I couldn't get across yesterday on my slides, and I came to this realization in the shower at my very nice hip hotel. I feel really cool in my hotel. I wish I had my dog, though. That's the only thing I miss. I wish I had my dog. I talk to my dog. Does everybody talk to their dog at home when you're all day long? Because I talk to my dog. We have staff meetings. We do all kinds of stuff. Is that okay?
So if you debit Joe's capital account, that's cash in his pocket?
Let's do that example, okay? Because there's a couple steps to answer your question. So transaction number one, and again, I don't want to get too mathy accounting-y, but I think it's a very good point. Thank you. When would this account be debited? When Joe takes money out of the business, okay? Joe takes $1,000 out of the business. A debit reduces an equity account. Joe takes money out of the business. A credit reduces an equity account, it reduces a cash account. So we have credited cash 1,000. Cash went down. I'm sorry, credit. Let me do two things. The cash account went down $1,000, so assets went down. That's what I was starting to do over here, and I didn't explain it. The capital account went down $1,000. Equity went down. Is it still in balance? Yes. Yes, the formula is still in balance. Okay? The other thing that's nice about T accounts, and it's tough to see it on QuickBooks, it's happening on QuickBooks, but it's tough to see. If these are the only transactions for the period, cash would have an ending balance of $4,000, 5 minus 1. Equity would have an ending balance of $4,000, 5 minus 1. You'll notice that the cash balance is a debit and that the capital balance is a credit. I know this is Greek to most of the audience. I'm only trying to take this as far as I can to get it to the point where you can use it. All right? Is that okay? What I would like to do, Brian, if it's possible, if somebody could log into my QuickBooks, and if I could pull up QuickBooks in a minute, sure. If that's possible. Yeah. I'm going to go one more step, and then I'm going to, if you guys could log in right now, that'd be great.
You can only do one or the other, so right now.
Please, we'll get out of the keynote, please. Mm-hmm. What I'd like to do is to take this, and I'd like to put it into QuickBooks. Yes.
Did you say this applies to sole proprietorship and partnership, but not corporation?
It's different for corporation,
Okay.
correct. Let me do, in fact, I'm glad you brought that up. Let me do how this would look for corporation. And then I'll go to the QuickBook. Thank you. Isn't this exciting? How come you guys didn't major in accounting? Boy, you missed out. You missed out. Come on. I started listening to classical music when I was in college because I'd come out of accounting classes and I'd just be completely fried. And the only thing I could listen to was, classical music. It's very relaxing. Now I've switched from classic rock and I listen to mostly jazz now. I really like Stan Getz and who else? Coleman Hawkins. I have a Stan Getz channel on Pandora I really like. Corporation. Slightly different. Same type of transaction, slightly different. Debit's still on the left, credit's still on the right.
And you're always using positive numbers, never negative numbers?
For this class, yes.
Okay.
For this class, yes. And yeah, I'll just leave it at that. Stick with positive numbers. We want to raise money to run our business again, but this time it's a corporation. Debit's on the left, credit's still on the right. This time we use an equity account that is not capital. It's called common stock. Now, we're going to see on a later slide that there's a couple of steps to this, but just to keep it simple for now. If Joe buys $5,000 worth of common stock in the corporation, I debit to increase cash $5,000. I credit to increase common stock $5,000. I got to hold this to get there we go. Assets equal liabilities plus equity. Cash went up $5,000. That's an asset. Common stock and equity account went up $5,000. That is an asset. Debits equal credits. Still, it's magic. It's the magic of accounting. Okay?
Right, it's an E because in the corporation the money stays in the bucket, or is that a C? Oh, okay. Just trying
If
to
E
make
is on the
sense of
right, we've got to stop the course and completely start over. Let's go back to segment 1. Welcome to Creative Live. We'll just go all the way back. No, I'm sorry. Credit.
Okay.
Let's go back in the time machine. Debit on the left, credit on the right. All right? Now, we want to pay an owner a dividend. A dividend is going to reduce equity. We're going to pay him a $100 dividend. We're going to debit equity. This is an equity account also. E for equity. $100. And we're going to reduce cash by crediting $100. Equity goes down. Cash goes down. Does the formula still balance? Assets went down $100. Equity went down, $100. Yes?
A dividend account for each shareholder?
Do you have a dividend account for each shareholder? That's a good question. In a corporation, It's not in the accounting records, but there is a bank that has an account for each shareholder. But it doesn't make it to the accounting records. Now, unless you've got a really small business and there's 3 shareholders, otherwise, no. Okay? Is that okay? Assets and both sides of the equal sign, balance, $4,900. If this was the end of the period, and we had to total up our cash, we'd have a cash balance of $4,900. If I netted out my equity and I took the common stock less the $100 dividend, I'd have $4,900 equity. Because these two accounts go together. Okay? That's a lot. I know we're going down accounting road, kind of heavy. But it takes everyone. It takes accounting majors multiple times. And again, my struggle in this course is to try to give you just enough that you need without giving you all your accounting merit badge. Because you guys don't want an accounting merit badge, I know. Okay? Maybe you do want an accounting merit badge. Let's say I want to do a transaction in QuickBooks. Okay? Picking up where we left off yesterday. Get my iPad out of the way. It's up to your own preference. In a transaction like this, where it's not really a sale and it's not an expense, I would go to Create, Journal Entry. Checking is my cash account. I'm going to debit it to increase it, $5,000. Go back to my previous example, because my example here is a sole proprietorship. I need a credit to make it balance, right? Because at the bottom we need to see debits equal credits. I'd like an account that's an equity account that indicates the owner's investment. I scroll down. Remember that the chart of accounts are in order. Assets, liabilities. Okay, here's equity down here somewhere. Equity right here. I'm going to hit an account called Owner's Equity because there's only one owner, Sarah, and we're going to credit her account by $5,000. I refuse to put my glasses on. I'm not going to do it. I really don't need them. And I'm just going to call that investment in business. As I said, I would hope that you use a memo entry every time. I'm even going to put the date. I'm going to call it 122, keep it simple. All right, I'm going to copy that explanation down to the second part of the entry. Now, why am I doing that? Because when you pull up reports in here, you do not always see both sides of the entry. If you pull up just cash, you're going to see that explanation. If you didn't put the explanation on both checking and owner's equity, if you pull up cash, you're not going to see the owner's equity side of the transaction. See what I mean? You need it on both parts of the entry. Okay?
What's the name field?
We use that name field for if you want to put in the name of a vendor or a customer when you're making a journal entry. Mm-hmm. Now,
So shouldn't you put Sarah over there?
there's only one owner, which is why I just put owner.
Okay.
You could, though. And you can make ideally, that's a good point. You can make an account up, Sarah's equity, Joe's equity, Paul's equity. Separate account for everybody. Because as I mentioned yesterday, in probably the most brilliant part of this presentation, I'm sure you remember it. Oh yeah. I talked about the fact that dealing with this capital, the next thing I'm going to cover is challenging. It's challenging. And you guys need to know this. And again, we're taking one more step down accounting road, and I'm trying not to go too far. Sarah's our owner of Image Photography. And Josh just suggested, well, shouldn't we have a separate account for the owner? And ideally you should. I just put owner's equity because we have one owner. Okay? Debits still on the left, credits still on the right. On my deathbed, debits will still be on the left, credits will still be on the right. Okay? I suggested to my children that when I get older, they can just take me up to Alaska and just put me on an ice floe and just push it. That's how they can take care of me in my old age. Debits on the left, credits still on the right. It's an equity account. We increase the account by crediting. So I'm going to put a little arrow up. We increase capital accounts by crediting. We reduce them by debiting. What we just saw on this journal entry was, I'll show you how we can get to it. Watch this. If I go to home page and I go to what I think is a clock and I look at recent transactions and I'm going to click on this journal entry I just made. There's the journal entry. Let me show you how I got there again. Clock, recent transactions, journal entry, there's the transaction. So, how did we increase equity? We credited $5,000. Because we put money in the business. Now let's say that Sarah, our owner, takes money out of the business. Now, for a sole proprietorship and a partnership with a capital account, you can call it salary for your own purposes. It's just taking capital out of your account. It could be profit. It could be some of the money you originally put in. Now, we talked yesterday about a loan. Somebody brought up a loan. Should I call it a loan to my business or not? And I suggest that you never call it a loan. You just put the capital in. And don't call it a loan. Ask your accountant. It gets complicated. Sarah makes a withdrawal of $500. We reduce the capital account by debiting. Now we're going to do it in QuickBooks. X out of this transaction. X, create journal entry. Now what I'm going to do is record the fact that owner's equity is going down and we're going to pay cash to Sarah, the owner. Click on my accounts, scroll down, there's asset, there's liability, there's owner's equity. In this case, I'm going to reduce it by debiting $500. By the way, everybody in the audience, in the live audience, is sitting at the edge of their seat on the couch. I know you can't see it at home. This is how I entertain myself. All right, got to do something. Checking. We credited $500 because we're paying her, right? I'm going to call it owner withdrawal. I'm going to abbreviate withdrawal with W, draw of capital. I was very impressed when I went into the green room and one of the people who's working on the other broadcast that's going on remembered my name. That was really kind of cool. She has a good memory. All right, just like we've got here, we are debiting to reduce her equity, which is the same thing as capital, equity and capital. It's a kind of equity account. We are crediting cash on the screen. So if I had a T-up account up here for cash, which I probably should, we are crediting that account and we are reducing cash and we're reducing capital. That's
Couldn't you do the same thing by writing an invoice to Sarah and having it on the invoice access these accounts?
I would not do it on an invoice because an invoice is considered to be a sale. I would keep that separate. That's a good question. Okay? So what we just did was we had Sarah put capital into the business, might be cash, might be film equipment, photography equipment, I should say. And then we had her take money out. Now let's look on QuickBooks and see what happened. We know that capital is an equity account. That's in the balance sheet from our formula. Cash is in the balance sheet. It's an asset account. Remember, assets equal liabilities plus equity. Cash, asset, capital, equity, they're in the balance sheet. So let's go look at the balance sheet. I got a couple ways I can get there. I'm going to go to reports. I don't know why I'm leaning over the table so far. Reports, balance sheet. We found out yesterday that you can click on numbers in this report. Okay? Another thing about accounting is, I say this all the time, set the numbers aside for a minute and think about what's going on in the accounts. All right? We get all so bogged down in the numbers. What about the accounts? Here's what I mean. I know from this transaction that checking went down by $500 when we paid her the cash. So I know in the checking there must be a reduction of credit for $500. And I also know that in the equity section somewhere, as I got to scroll down, I'm going to see equity change for that $500 payment also. Okay? Looks like that's wrong, but I'll take a look. Oh, you know what? Let me make sure I've got all the days in here. I'm going to go out to February. Okay. Run the report. Let's click on checking. Checking. Shows all my transactions. Yes? Oh, I thought somebody raised their hand. Sorry. Look at the bottom here. Somebody said you're not using negative numbers. In this report, you're going to see negatives and positives, the in and outs for cash, but look what's going on at the bottom. We had an investment in the business of $5,000. We had a withdrawal of cash of $500, so my cash adjusted. Now, I'm wondering about the capital account, the owner's equity, because that doesn't look right to me, but we'll pull it up and see what happens. Oh, no, it's right. So, because I had a prior transaction, I forgot. So, owner's equity section, there's the investment in the business, increase, positive number, increased equity, payout, $500, reduced equity. So let me do that one more time and try to tie the two together. If I want to see this activity that I posted in journal entries, in QuickBooks, in here, they are both balance sheet accounts. Cash is an asset, owner's equity is equity. I pull up reports and I go to balance sheet. If I click on cash, voila. Investment in business, increase cash $5,000. That we saw that on the board. Pay the owner, reduce cash $500. Saw that on this flip chart. Go out of the report, back to summary report. Go down to equity, owner's equity, $5,000 invested in the business, increased it on the screen $5,000, paid her out, withdraw, negative number, reduced it, $500. So what I've tried to do is to take the debit, credit, T account stuff, put it in a journal entry, and show you where it is on QuickBooks. That is a lot to throw at you guys in the period of time. What questions do you have? Maybe you have, I know that's drinking out of a fire hose to an extent.
Could you do this another way, like through transactions, possibly on the left-hand column there, under the...
Right here?
No, keep going.
Keep going, keep going, keep going.
Down.
Here.
Yep. A banking, that's like a banking transaction.
Let's click on it. We're not going to do the credit card and debit, the download stuff at the moment. You have downloaded transactions in this section. So
Oh, I see.
this section is really for downloading activity, but actually it's kind of nice that you went to this because you can accept transactions or unaccept them depending on whether they're accurate or not. But to answer your question, I would prefer to go home, create, and remember this is an expanded window. I would rather be create right here, show more, journal entry for this stuff. Now, again, as I mentioned yesterday, home. If you're going to do invoicing, you might want to go to transaction sale to do a new sale invoice. You may want to go there instead. As I said, I'm old school and I'm all about going to the create journal entry because back in the day, that's what we did. We didn't have all this tech. We didn't have go to sales, create an invoice. We didn't have it. It's old school. Other questions?
We had one come in on the internet. Jojo had asked if we use that create button for sales, invoices, et cetera, then the journal entries are automatically created and both sides of the equation are balanced for us. And they're basically asking, is that correct?
That
Do
is
they understand
correct.
that correctly?
So let's talk about that for just a
Okay.
second. If I go to sales, create new, invoice, that gets posted to sales and accounts receivable automatically. I'm going to do some of this later in the class. I just didn't want to go that far yet. If I go to expenses, create a new expense. If I create an expense in here, it's going to get posted as an account payable automatically. Yes. The answer is yes. Thank you. What else? You know, you could do accounting all day long like this for a living. Isn't that amazing? How much fun would that be? What are you doing today? Accounting. What about tomorrow? Accounting.
We have a question here from Renata, and they want to know, what if the two partners have not invested any money, just their time, and the business is making profits? One partner is drawing salary, but the other one is not. Does that affect their ownership split going forward?
Chris, I'm going to ask you to read that one more time.
Yeah, no problem.
Okay, could you run it by me one more time?
Yes. So they're asking about what if two partners have not invested any money, but just their time, but the business is making profits? So one partner is drawing salary, but the other one does not. Does that affect their ownership split moving forward?
Whew, that's a lot. Okay. This brings up a critical point which I haven't covered, which is, in accounting world, in a business, you have to have a number in here for equity eventually. However, and this is tricky, for this class, I'm going to say that it's possible to start off and start doing business and have income and pay expenses and have income with no equity created at the beginning. In other words, there's no contribution to capital and stuff. All right? Here's how that might work. How am I going to do this? Real quick. You have $100 in revenue. You have We credit to increase revenue. You have $50 in expenses. We debit to increase expenses. Okay? That means you have a profit of $50. And we said there's two things you can do with the $50. You could pay it out to the owners. It would be a dividend to a corporation. It would be return of capital to a sole proprietor or partnership. You can keep it in the business though, right? If they have two partners have profit, they have a profit. They can keep that in the business, and if they keep it in the business, it's equity. They created equity by creating profit. Okay? So that's how capital gets created. Okay? Now, let's say a partner is drawing out. So we have plus 50 for equity. And then we have a partner pay himself $10, so now there's only $40 in equity. Okay? That salary in a partnership, that just would reduce the capital account for that partner. So that subtraction of equity, that just reduces Bob's equity, Bob's capital. Let me do that again. Start a partnership, nothing's deposited for equity. Sell some stuff, have some expenses, $50 profit. That's equity. Keep it in the business. We pay $10 out to Bob. Equity for the whole partnership goes down. Bob's capital is reduced for that equity. Joe's capital is unchanged. They both had 50 total. We pay 10 to Bob as salary. Total equity goes down. Bob's capital account goes down. And that's the way a lot of businesses start. That's fine. Particularly in fields where you're expertise driven and you're not, manufacturing anything. Okay? Mm-hmm.
So Bob and Bill in the beginning had that discussion about who gets what.
Yes.
So the same thing with the person on the internet, they need to agree in the beginning how they each get paid.
Absolutely.
So forth.
Yes.
Okay.
So, if I had something I'd like you to take away from this and do is just as Renee mentioned, is please have that who gets what discussion if you're going to be in partnership with other people or start a corporation. The other thing I would like you to do is to consider keeping very close track of what's going on the money you put in your business and take out. Okay? I mentioned earlier in this segment the importance for a corporation of separating business from personal transactions, which is going to be something we go into in our next segment.
All right,
Terrific.
great. Yeah, it is about time. Well, do we have one more question?
Yeah, so for them to keep track of what they have, you should have a separate equity account for
Yes.
each person.
Mm-hmm. You bet. Separate capital accounts. So Bob has his, Joe has his. And they add up to the total equity.
Great. All right, well, we are coming up to our 15-minute break. And I know in this segment we did talk all about forming your business. As you mentioned, we're going to be talking about separating business activities from personal transactions. Anything you want to tell everyone before we take a break about that?
It takes a lot of self-discipline to do this, particularly when you're starting your business. I get that. I got to set up another checking account, and I got to reconcile 2 bank accounts. But in the long run, it is worth it. It is worth it. Mm-hmm.
Great. Now, I do want to share a few comments that we have. One really funny one serious one. But earlier, your comment about talking to your dog. We had someone in the chat room, Rhonda Grew, who says, I don't have a pet, but I talk to my children. I get a better response, usually.
I love that.
And then a serious comment from Casey Aloha, and they said, I feel so much more prepared for my taxes this year. Ken is really helping to break it down into the basics, and I'm not as afraid of the numbers as I have been in the past.
That's great.
Yeah, I mean, and that really summed it up. He's not really afraid we got to break it down to the basics in order to really plan our finances to the best of our abilities. And just in this one, when we're talking about forming our business partnerships, that's so important, in my opinion, to do that in a way that you protect yourself and you also set yourself up to build the business that can be as successful as possible. So thank you, Ken, for providing us with all of that. And I want to remind everybody that we have some great bonus materials that come with enrollment, and we're going to talk a little bit about them later on in the course, but I just want to remind everyone to go in there and enroll in the course. It is free to enroll, and you will have access to those bonus materials that come with enrollment. And in addition to that, this course will normally be $149 right now during the live event. It is that live discounted $99 price. And when you purchase the course, you also have access to all of the keynote presentations. So everything that we have right here, in addition to each of the course videos, you'll have that keynote available to you with the formulas and everything that you see on it. So if it's something that you think you're going to purchase, I'd highly suggest that you purchase it while we have the live discounted price available to you. And also, before we go, I want to make sure we've shared with everybody, we mentioned this yesterday, but we're all so excited about it that I have to share again. The Creative Live has been nominated as Best Educational Startup in the Crunchies, which I'm excited. Chris, I know you're excited.
It's a tremendous honor. There are a lot of companies doing great things in this space, but obviously we're really proud of our efforts here at Creative Live. We hope that you guys have been enjoying what you've been watching, and the best way to show your support is to vote for us to win this Crunchie.
Absolutely. You can vote for us by going to the URL that's on your screen right now. And you can vote once a day, every day, up until, I think, the 29th. I believe it's the 29th. It might be the 26th.
Yeah, so
I'm
get
going to
those
double check
votes
that.
in there now.
Yeah, absolutely. We definitely appreciate it, and we will see everyone back here in 15 minutes.
I'm learning to tell better stories.
I'm learning how to manage 200 emails a day.
I'm learning how to get my art in front of a larger audience.
I'm learning.
Welcome back to Small Business Finance Basics, QuickBooks and Beyond with Ken Boyd right here on Creative Live. We're entering into our second segment of day 2 of this course. And last segment, we were kind of just talking about forming your business and the things that we need to do that, talking about business partnerships and whatnot. And now we're going to get into separating our business transactions from our personal transaction and what all of that entails. Is that correct?
That's right.
Great. We're looking.
The purpose of this is really to, I kind of lost my train of thought there for a minute.
That's all right.
To continue on, now that you've got some business formation, how do you come up with a record-keeping system?
Great. Well, I'm looking forward to it. And I kind of reminded everybody just before the break, but I wanted to remind everyone again that there's also some really terrific and useful bonus materials with enrollment. So you can enroll for free. And one of those is this book list of yours. Can you tell everybody a little bit about the book list and what they might find on that?
Yeah, one of the things I mentioned in the last segment, The Smartest Guys in the Room, the Enron documentary is something I recommend. But in addition to that, there are books that have helped me over my career that I still refer to, that I still have, that are on the book list, and so that's why it's a bonus material. Terrific.
And then in addition to that, there's also the small business formulas. And we've gone over some of them already, and I think we'll touch on more as we go on. But just wanted to remind everybody that that is there and available to you. And we'll go ahead and get started.
Okay,
Thank
thanks.
you.
Thanks, everybody. So this segment is called Separating Business from Personal Transactions, and I'm going to click on the slide. Well, let me go back. Back. Sorry. There we go. So I've got my bullet points here of some things that I'd like you to think about initially here. I'm going to make sure my phone's off. It is. So why do you need to separate? I think I covered that in the last segment. One of the reasons you need to separate business from personal is because of legal liability issues. There's a term out there called piercing the corporate veil, which is a fancy way of talking about the idea that if you have a corporation and you commingle the business and the personal activity, particularly in a checking account, that someone who's pursuing you legally could say, well, look, they're intermingling their transaction. There really is no difference between their corporation and their personal assets. Therefore, they're one and the same legally. And again, this is stuff for an attorney. But it means that if somebody slipped on the floor and fell outside of your pizzeria and you were a corporation, but you were mixing the business and the personal transactions, a judge might say, well, your personal and your business are the same, therefore all your personal assets are up to grabs in a legal matter. So that's called piercing the corporate veil, which is kind of a legal business law term. Now we got to attach some accounting to separate those records. And in the who gets what discussion last time, we'll talk about, well, which responsibilities go where. I'll do more on that. And then I'm going to tell an unfortunate true story about something called a fictitious payee that happened to a client of mine before I worked with them that ran a tree service company in St. Louis. It's kind of a cautionary tale, all right? So first of all, why the need to separate? And I'm going to pull up my notes here as well. There's a legal issue for separating, but there's also just plain old accounting profit and loss issues, okay? Here's what I mean. This is a case of you starting a business, not separating your records, and getting so far down the road that it's tough to separate stuff after the fact. For example, you've got a checking account. You start a sole proprietorship, and at the time you decide, I'm not going to separate my records. I'm going to use P for personal. I'm going to use B as in boy for business. B-U-S for business. So, one checking account. You write a check, it's personal. You write a check, it's for business. Now, here's what happens. It's a good problem to have. Your business starts to ramp up. So suddenly, checks that you're writing for your business go from a couple checks a week to 10 a week. And deposits, hopefully, that you're getting from your clients go up from 5 a month to 30 a month. And so what happens is, as you're writing more and more and more checks, more and more of them become business checks. And more of your deposits become business deposits. I'm going to put a B by deposit. Which is a good problem to have because that means that you're doing a lot of business. Good problem to have. However, if you're in this situation and later on it's tax time, and what's your accountant going to say to you? Can you separate out all the business activity that's in your personal account? I can't tell you the number of times that I've had to deal with people who've had to do this. There's a couple of risks. The first is maybe you don't pull out all the deposits, so your income, your revenue and sales is too low in your accounting records. Maybe you don't catch all the checks that you've written. So you show a whole bunch of revenue and far too little income and far too little expenses because you didn't catch all the checks you wrote, and you end up paying tax on a profit that's too high because you didn't pull out all the expenses. There's a whole bunch of reasons why this issue can be a real problem. Okay? So there's a practical reason why you should do this, not only because of the legal liability that I mentioned earlier, but also because it's just tedious and time-consuming to do this. So that's a reason. Okay? I'm going to flip my page on my notes. So the scenario I have that Sarah starts image photography. That's the business that we see on QuickBooks. She uses her personal checkbook for 3 months. So you can imagine if business starts rolling, this is going to be a lot to separate after 3 months. So I just want you to consider that there's not only a legal issue, but there's also a practical time eat up your time kind of issue, okay? So what do I do suggest? Well, this goes back and relates a little bit to something that we did in a prior segment. I'm going to connect some stuff we did in a prior segment. It's kind of organizational, administrative, but it's important. You start a sole proprietorship. As we mentioned in business formation, you go to the Secretary of State and you register a fictitious name. Okay? Let's say it's Riverside Photo. Why do I go through this? Because once you get to this step, you can now go out and get a checking account set up. So here's Sarah, our photographer over here. She's got her personal checking. Riverside is going to have their own business account. 2 bank accounts, okay? There's a practical problem, and part of this is just personal, kind of organizing yourself. Many business owners that I know are carrying around checkbooks for both business and personal, and carrying around bank cards, debit cards, credit cards, both business and personal. You just have to discipline yourself to take a minute and look at which checking account you're using, which reminds me of a story that happened to me Tuesday morning. I'm going to fly to San Francisco, and I'm super psyched to do my Creative Live show. So I'm kidding with the guy at the counter, and I'm not going to name the airline because you know where the story's going. I'm kidding with the guy at the counter, and he hands me my boarding pass, and off I go. And I get lucky, and I get in that TSA pre-line, the short line. Man, things are going great. And I hand my ID and my ticket to the guy, and he hands it back to me, and he goes, "This ticket is not for you. This is for somebody named Buyer. Your name's Boyd. This is not your ticket." So I go back up. Because I never looked at it. Because that guy handed it to me. So I go up and I got to get my ticket changed and blah, blah, blah. It takes some self-discipline to do this. That is, it takes self-discipline to use the right credit card to write the check out of the right account. It's just something you got to kind of accept and learn to do. Okay? So that's my suggestion on separating the accounts. Okay? Now there's an accounting issue here. That goes beyond administrative. So I said on the why the need to separate, there's a tax issue, business transactions in your personal tax return. What we learned in the last segment is, and this is worth repeating because it's kind of complicated. You've got a personal tax return. You've got the income section of that return. One of those lines is for your business, Riverside Photo. So I'm going to put $10,000, Riverside Photo. Profit. Okay? This profit is only correct if you've been diligent about separating those business and personal transactions. It is only correct if you keep them separate. There is a personal financial impact to you if that number is wrong, because that's the number you're paying taxes on. So let's make, it's worth the effort, is what I'm saying, to get this right. Okay? Personal assets separate from legal liability I've covered a few times. So who cares, Ken? So what? So I use a personal checking account and I separate business from personal at the end of the month. So what? Well, let me take it a step further. Another need to separate records is to generate accurate reports. Now, we've been putting stuff into QuickBooks. Who needs the reports? Here's the new point. And this gets back to something that Jackie O was talking about yesterday, which is, well, let's look down the road and talk about venture capital, angel, and you got to kind of put your best foot forward. All right? Who needs reports besides you? It says on the screen, investors. There's going to be two problems if you do this commingling. First of all, if somebody's willing to invest in your photography business, if somebody comes to you and says, you've got a lot of talent, but I can see that you need another investor to come in and put some money in so you can buy more equipment, and I'm going to help you do that. And you say, great. Obviously, he wants to see your financial records. It's going to look pretty unprofessional if you've got to spend a week separating your business and your personal transactions because you don't do it until the end of the quarter or the end of the year. Because you never know. Somebody might approach you and say, I'd like to invest in your business. So you got to kind of be ready for that, is my point. A reason to separate business from personal. A lender, commercial banker. He's going to want to see some accounting records, a financial statement. Let's not, and I've seen this happen. I've seen people who need to get capital and want to get a loan, or they have somebody approach them about being an investor, and they literally have to put the entire thing on hold while they separate business from personal transactions. So please don't do that. Please keep that in mind. A new business partner. New business partner. You can imagine that the fact that you're not separating business from personal transactions doesn't reflect on the business owner well if it's a new partner. Because to be blunt, it gives the impression that you're maybe not professional, or that you're not taking this seriously, or maybe you're just a little out of control. Okay? That's what I'm getting at on this partner thing. I'll give you an example. As someone who is a business owner who's approached by somebody else. So I got approached by a guy who is creating a new online education company. And not that I'm any kind of big deal. That's not what I mean. And he wanted to talk to me about using my YouTube content and other things that I've done and combining it, et cetera, et cetera. Well, great. So I asked the guy, I need to understand some basics of your business plan and where you're going. I'm willing to sign a confidentiality agreement. Absolutely. You own the idea. But before I invest a lot of time talking with you, I'd like I'd like to know where you are. And the guy wouldn't send it to me. And he said, well, that's for investors. And I said, well, yeah, if I'm a partner, I'm an investor. And so I wish you luck, but I'm not really interested. Because my intuition, my impression was, maybe the guy doesn't have a business plan. So you can see that's how a partner might reflect on a business owner. Maybe they don't have their act together. And that's what I want to avoid for the creative folks out there in the audience is, I understand it's accounting and it's not as critical as your work, but it gives the impression that you kind of got your act together a little bit without becoming an expert. So those are people who need your reports. So I use the example of my friend who's got the catering business and a restaurant wants to invest. And they want to see, what profit have you made historically? How much in sales have you done? What kind of equipment did you have to not only make the food, but deliver it to clients, that kind of thing? How much expenses have you incurred for hiring staff? You know, they kind of want to see the picture. Now again, I would insist on somebody signing a non-disclosure agreement, but you're not going to connect with these people if you're not separating your records, is my point. Okay? If you come away with nothing else from this class, this might be the most important thing. And it really doesn't have to do with QuickBooks, but this is so important. Duties that you should separate. Accountants call it segregation of duties. This is an instance where you assign to different people things that you do in your business from an accounting standpoint when possible. Now, I realize if you're on your own, if you're like me and you're a one-man band, not applicable. The problem comes in when your business is growing and you're at that point where you have to hire that first employee or employees, plural. And in your euphoria and in your hurry, you don't think this process through, and problems happen. Where possible, assign the work to different people. Now, what are the duties we're talking about? Custody of assets. The first bullet point. Who physically has the checkbook? If you're a plumber and you have 5 trucks and a whole bunch of equipment in a warehouse, who has the keys to the warehouse? Who can access if you've got inventory? Who can access the inventory? The physical assets that you own. Who has access? Who can change your website? That's not an asset we necessarily put on the books, but that's important. Who has access to your website? Custody. Authority. To move assets. Who can sign a check? Most companies have something in place where above a certain dollar amount, there needs to be 2 signatures on a check. That's a really good idea because then and we got to think a little more. We have 2 signers on a check over a certain dollar amount. I'd recommend that. Who can write a check? Sometimes people have custody of the assets. Maybe it's the administrative person at the front desk has the checkbook in her drawer, but she's not an authorized signer. Never, 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 ever let your accountant have access. Never let your accountant be a signer on a checkbook. Ever. Ever, ever, ever. Don't let an accountant have authority to move assets. You're going to find out why in a minute. And the final is the record keeping. Records. Who has access to QuickBooks? Now, we found out earlier that you can have multiple users for QuickBooks. That's cool. But you need to be aware of who can actually make transactions. You may want to set up something where even though you have a bookkeeper or an accountant who has access to QuickBooks, that you review their activity. All right? 3 things. Custody of assets, authority to move assets, record keeping. Now, this sounds like business school administrative stuff, but it's really important. I'm going to give you several examples in addition to the one that I have on the keynote of what can go wrong here. Okay? Questions on that before I go on, that basic statement? Okay? My friend Dave, who I talked to this morning in my super cool hotel room, referred me to a guy 10 years ago who owned a tree service company. I'm changing the name to protect the innocent. We're going to call it Green Rivers Tree Service. Did about $600,000 a year in sales. You had the owner who was going out and making estimates. You had a person in the office who was handling the accounting and the scheduling and dispatching people. You had crews. The owner would take out crews to go do the work, and a manager would go out and would do work. Okay? So anybody had a tree taken down at their house lately? Yeah? So they show up at your front door. Did they give you an estimate? Yeah. So they show up, they got the clipboard, they give you the estimate. So the owner and the manager managing another crew, 2 crews, would give people estimates. A nearby town has a storm, about 30 miles south of St. Louis. Big storm, lots of trees down. Owner sends manager and a crew to go do work down there. Boy, they got all kinds of work. Lots and lots of trees to be removed, taken down, etc. Sends the crew down. Dispatcher gets calls. They send the crew down. Crews come back every day, figure out what equipment they need for the next day. They've got all these estimates in the hands of customers. The dispatcher schedules all these jobs out of town. Off they go doing all the work. Shortly after all the work's done, the manager supervising the crews in the nearby town suddenly quits. Week goes by. None of the payments are coming in from the work performed out of town. Owner decides, I'm going to take the guys who were on the crew that worked on those jobs down to the town and figure out what's going on. Why am I not getting any checks? He starts showing up at people's houses. The crews, they've got down the addresses. Crews said, yeah, we took out a stump there and we took down a tree there. They show up and start talking to clients. Yeah, they did the work, I paid you guys. Well, how? What? Finally, one of the customers shows them the invoice that they were handed because the manager, who has now quit, had authority to not only do the estimate but hand the person an invoice. And they had a stack of invoices that were not numbered, a stack of invoices, templates that you could fill out and hand to customers. What the manager was doing, as it turned out, he was handing the customers invoices for a slightly different company name and an address and a P.O. box that he controlled and a checking account that he controlled. And he stole $50,000 worth of business for a company that only did $600,000 a year total a year. $50,000 gone that the guy stole. And as soon as he billed everyone and invoiced them, and he knew that they all had the invoices in their hands, he quit the business. Now, I walk into this after this has happened, and my friend, the owner, says, I've got an attorney, and I could go after the guy, but the attorney fees would be more by the time I get to the end of this than the 50 grand I lost. So I'm not going to pursue it. So I just lost. Not only did he lose all the revenue, but he also lost all the spending he did to get the revenue. So he actually lost twice. He lost the $50,000 in revenue, and then he lost all the cost to generate the $50,000 in revenue. So if it cost him $40,000 to make $50,000, he lost the $50,000 in revenue, and he lost the $40,000 in expenses. That's $90,000. For a guy that's has revenue coming in of $600,000 a year, that's 15% roughly of his business, of his cash. It's crazy, more than that. This really happens, and it happens because too much responsibility is given to someone, and business rolls along and things are going great and you don't really think it through. If you, in a major city like this, or where I am, if you read the paper, the local section of the newspaper, every week You'll read about this happening every week, guaranteed. So how do we prevent it from happening? Couple ways. Now, I have a scenario here, and I'm going to give you some others because there's a couple other ways where this scam can happen. Here's how you should handle billing. The great thing about QuickBooks is it generates an invoice that's numbered. So you should use numbered invoices. There's a number side. So you can account for each numbered invoice. So if invoice number 6 is out there and it hasn't been paid, you can follow up. And you only give your clients the numbered invoice, whether it's from QuickBooks or your own system. You never let anybody else create, manipulate an invoice, ever. You hang on to that. Okay? The problem was here the manager had 2 duties that should be separated. He controlled the invoicing. He just had a pad. You write them out and hand them to people. And he had the ability to completely avoid the accounting process because there was no control to let the owner know who was billed, what the number of the invoice was, how much, what address were they given to send it to. So you as an owner need to keep control of that, okay? So you want to use a numbered invoice. You personally email, hand deliver invoices. Don't let other people do it for you. You account for all these invoices. You make sure you know, have I been paid? Has it been given to the client? All that. Don't let that out. Now, if you're a big organization, you start putting some controls in place and you've got other people doing it, certainly. But as a creative person starting a business who's hiring somebody, it may even be somebody you're hiring full time, it may be just a bookkeeper. Make sure you handle this, okay? Let me give you one other one, and I'm just going to scroll here to make sure. Yeah. Give me 1 second. I want to talk about a different type of theft that can occur not on the billing side, but on the ordering side. Not on the billing side, but on the ordering side. This is an example I used, and I've lost track. It might be in one of the books, I can't remember. It's a common, generic problem, all right? You own a restaurant. And you obviously you have a supplier that you buy meat and fish from. I know a guy who's in this business in St. Louis. He gets up at 3 in the morning every day, and he flies in fresh meat, produce, very high-end stuff, and he gives it to all the high-end restaurants in St. Louis. That's his business. So you order meat and fish from somebody. Let's call it Armor Meat, and that's your meat and fish provider. That's a vendor. We talk about vendor in QuickBooks. So here's the process of ordering stuff. The manager of the restaurant fills out a purchase order that says we need a certain amount of meat. We fill out a purchase order. The purchase order is not you buying the stuff. It's not a bill for stuff. The purchase order is simply telling your folks, I need to buy something. All right? So he fills out a purchase order. And that goes to an owner who approves it and says, yeah, we probably do need that much stuff. That's that approval process. Now again, this may be a little bit beyond the scope of many people who are watching, but you need to start thinking about this process as you grow your business. Because if you're a filmmaker and you get big enough where now you've got to have somebody order stuff for you, this is what I'm talking about. And the other thing is that these thefts can happen in very small amounts for years and years and years. There was a situation in St. Louis, actually two. I'm aware of a situation because unfortunately the daughter of the lady who did this went to high school with my oldest daughter, who was the controller of a car company, of a local car dealership. She stole money from this car dealership for 6 years before she got caught. She stole millions of dollars, and it happened over 6 years. And it all came crashing down when her daughter was in 8th grade with my daughter. It's terrible. So it can happen over years. So if you're ordering film equipment and you don't have this set up right, they may not necessarily steal money from you all at once, like this guy did. It may be very small amounts for years and years and years and years. And then you find out about it later, and I'll talk about how you find out about it. So I just want you to be aware, it might not be a big dollar amount at the beginning. It may not be noticeable, and it's intentional that it's not noticeable. It's intentional, because they can steal a little bit along the way without getting noticed. So the manager approves the purchase. You receive the goods. So you're a filmmaker and you order, 5 pieces of equipment, and they come in and you open the box and you compare what you got, and there's normally a shipping document, right, when you order something? A shipping document with the purchase order. Did they send me what I ordered? Okay. Last step, the owner is going to look at the purchase order, the shipping document that shows what they ordered, and he's going to he's going to pay the invoice that they sent. Okay? That's an ideal process for buying stuff. Okay? Let me give you an example of how you can have a theft problem on the ordering side. Okay? In the trades, and I mentioned I do a lot of people in trades, plumbers, carpenters, roofers, there's lots of guys doing side jobs on the weekend who are using equipment sometimes from the employer they work for during the week, and things get lost. Okay? That's a reason you need to have controls over custody, and I'll talk about that one next. Let me give you a scenario where you can have a problem here. Let's say that the manager sets up a fictitious account called Armor Central Meats. It's a similar name. Fictitious company. He controls bank account, whole thing. All right? Manager decides to go in cahoots with the guy who handles the shipping clerk. And they're working together, and we call that collusion. If you ever took a business school class, collusion is where 2 or more people get together to commit a fraud. 2 or more people, we call that colluding, all right? These two, here's what they do. They hand the owner a purchase order from the fake company to buy meat. It looks like a similar name, doesn't it? Owner says, fine. No goods are ever shipped, but they create a fake shipping document that says, yep, the goods arrived. So now you've got a fake purchase order to this company. You've got a fake document that said the goods arrived, and what's the owner going to do? He's going to pay an invoice based on a fake shipping document and a fake purchase order. That can happen. Which brings up an important point, which is, if people collude if people work together to collude, it's very difficult to catch, okay, in a large organization. If two people work together, all these accounting controls I'm showing you don't work if two or more people collude, which is why many big companies have outside auditors come in, because the outside auditor might have a shot at finding somebody who's doing this. Now, again, to keep this on the scope of the people in this class, this is a situation that can happen, both the ordering issue and the billing issue, when you hire that first employee. When you hire that first employee, okay? One more on this topic, which has to do with assets, custody of assets. As I mentioned, they're building a house down the street from me. I know that because at 6:45 both Saturday and Sunday morning, they had all kinds of equipment making noise. So, they must be doing construction. I know because I talked to some of the guys while I was walking my dog that there are guys who are working on this job who work on side jobs. There's a risk in that, there's a risk there. And there's the risk is that employees use equipment for personal use for their side job and they don't return it. Now, many companies say, hey, that's cool. If you want to do a side job and you want to use a stub grinder or this or that or this piece of equipment, go for it. Just make sure you bring it back. This becomes a problem for bigger companies that are plumbers, carpenters, and in your case, if you're in an occupation where you have, like a film person, a photography person, lots of equipment, and equipment that you have to update and replace all the time. So how do you do this? How do you handle this issue? I'm going to call it inventory. What I'm suggesting that you do is that you tag your inventory. So you got a camera and that's number one, and you got a tripod and that's asset number two. See what I mean? And in your fixed asset listing, which I'll do in QuickBooks in a minute, you've got these assets, but they have a physical tag on them. A tag on them, okay? And again, how much accounting do I have? This is important because this is going to prevent theft and even loss. It slips your mind, you make a mistake. So when you have inventory, you need to tag the inventory items. Now, the example I always use, at the dollar store, if they've got a bin of pencils at the dollar store, I'm not suggesting that the dollar store tag all the pencils. I'm saying that if it's of a decent dollar amount, you should put an inventory tag on it. Okay? And every once in a while, you should count the items and make sure you have them all. Now, practically, you guys are probably doing this intuitively anyway. You're kind of doing an accounting to make sure you got everything. But as your business grows, you need to be a little more structured about this. You need to be a little more structured about this. Okay? Just to take it one more step to give you a little feel for what I mean. One of the things you do when you're an auditor is you do audits and where you count inventory, because you can imagine if you're a retailer that one of your biggest assets is inventory. So how do you verify that the inventory is there? Well, you got to count it. Okay? So how do you count it? Well, you're going to take the tag list, the list of tags, and you're going to agree it to each inventory item that you have listed in QuickBooks, QB QuickBooks. So you're going to go into QuickBooks and you're going to print off, Here's my fixed asset listing of all my cameras and all my stuff. And you're going to take the list and you're going to go out to where you keep your stuff, you know, the warehouse, wherever, and you're going to make sure that you have all these items. Okay? Does that make sense? Questions on segregation of duty? Yes, Josh.
So you go out there and there's stuff missing, then what?
Okay. Josh, there'll never be anything missing. For you. Never. It's perfect. No. So if there's stuff missing, okay, if you're a sole proprietor, maybe you've misplaced it. But if you have employees, how do you prevent this from happening? You have to have people sign out items and sign them back in. Sign out, sign back in. Okay? And in. And that's how we track it. So you go back to if you're missing the tripod, you go to the person who signed out the tripod. Where's the tripod? Okay? Mm-hmm.
I have a question. We keep talking about employees. And at least in some of the business I own, it's better to hire people as consultants as opposed to employees for some of my bookkeeping. So is there any reason why, like in other people's profession, why employees versus consultants?
We're going to cover that later.
All right.
But for the purposes of this discussion, anybody, I'm going to say it more broadly, anybody that is involved in your business, you need to have these controls for, regardless of whether they're employee, independent contractor, consultant, freelancer, however we label them. Okay. Other questions on segregation of duties? Okay. If I could have, well, let me see if I can do it myself. I can. Oh, look at this. Some people do it. Man, technology. I can do it. So exciting. Okay. I have QuickBooks pulled up on the screen now. Man, I did that myself. That was amazing. What I'd like to talk about is this inventory thing and take that a little bit further in QuickBooks. Not only inventory, but fixed assets, okay? Let's start off by going to our chart of account, our create. Yeah, let me go. I want to go to the wheel, the magic wheel. You know the Wheel of Fortune is still on TV? How old are those people? How old is Pat Sajak and the ladies? Man, I turn it on, I'm like, this is still on? It's amazing. What a run. The only job you'll ever have, Wheel of Fortune. Okay. I mentioned that we have a chart of accounts when we go to the wheel, when we hit settings. Your QuickBooks may have accounts set up for both inventory and fixed assets. So let's scroll down. So we've got checking account receivable, undeposited funds and assets. I'm not going to cover, we really don't use. I created one asset called umbrella backdrop. But for the purposes of this most basic level of QuickBooks, there's not other fixed assets, there's not other assets listed or inventory listed. Okay? So what I'd like to do is, let's do a fixed asset. So the next thing I'm going to do, just to keep this on track, create a fixed asset. I got a new asset, I got a guitar, I'm trying to learn how to play guitar, but I'm not allowed to play it around anyone else. Everybody leaves the room. At home. So, let's say the first thing we're going to do is we're going to buy a fixed asset for cash. Go into QuickBooks. Again, I'm old school. I'm going to go to the magic wheel. No, I'm not. I'm going to go to Create, Plus. I'm going to pretend this screen is not extended. I hit Show More. I go to Journal Entry. We are buying a fixed asset for cash. Christine, what would be another example of a piece of film equipment?
Buy a camera.
Let's just say camera. Okay. I do not have an asset listed here called camera. I'm going to hit Add New. Category type. So I start in the top left-hand corner. Drop-down menu. It's a fixed asset. Now remember, a fixed asset is something that you're going to use to make money over a long period of time. Might be months or years. Just so that's what a fixed asset is. All right? Type. Camera. Now, Josh, I remember mentioned the sub-account thing. It may be possible if you want to have a camera asset and then have 5 different cameras below it as a subcategory, you could. That's what that is sub-account means. Okay? I'm not going to put a beginning balance in because I'm going to make a journal entry to do that. And I would suggest that you not mess with this beginning balance because you should do a journal entry to create a balance, all right? Is everybody cool on that? Fixed asset, camera. Hang on. I've got to do one more thing on the type of fixed asset. I'm going to call it depletable. I don't even know that I want to use this. I'm going to call it machinery and equipment. Now, it's kind of nice because when you click on that, QuickBooks gives you a little description of what it is, what that means. So it says, use machinery and equipment to track computer hardware as any other non-furniture fixtures or devices owned under your business. So I create an asset account called camera. So how much is a camera you might use, Christine?
Oh, let's spend $2,500 on it.
Okay. I don't know if I have that much cash in this example.
Let's spend $500.
All right, thank you. I'm going to reduce cash. The only cash account I have is bank checking. There. Oh, now Renee told me I can right-click.
Only if you spell it wrong. You haven't spelled anything wrong.
I haven't spelled anything yet. Okay. Purchase camera for cash. Again, I'm going to copy that memo entry down. Copy, paste, purchase camera for cash, save and new. Now, again, what did I just do in terms of a journal entry? Debit's still on the left until my dying day. Credits are still on the right. I increased an asset account called camera, $500 debit. I decreased an asset account called cash, $500 credit, okay? Next point, and we haven't covered this yet in this class. We're going to depreciate the asset. Now, depreciation is defined as the decline in value of a fixed asset. Depreciation is defined as a decline in value of a fixed asset. Why? Because you're using the asset. You're using it up to make money. Okay? First step, we're going to create a depreciation expense account, and I would recommend that you do it for each asset you own. It gets back to a point that I made yesterday that I will do again. Okay? I need to do a journal entry to depreciate the $500 asset. Okay? I'm just going to say oh, before I do that, let's go to reports. Let's go to balance sheet. Let's go to assets. There's our camera, $500. Everybody see that? If I click on the number, there's the journal entry. I click on the journal entry. There's the transaction. Okay, let me do that again, because it's Word. It takes some getting used to. Report, balance sheet. I scroll down. Here's the assets section. I go to fixed asset camera, $500. Now remember, why did Ken put a memo item on both the debit and the credit? Because this only shows one part of the transaction. I got to click on journal entry to see both parts. All right? Is everybody all right with that? Okay. We are going to depreciate the asset, which is the decline in value of an asset you use in business. Okay? Magic plus sign, create, journal entry. I do not have a depreciation. Yes, Renee, I'm sorry.
Is there a formula built in for the depreciation for the item? Is there a general?
On more sophisticated versions of QuickBooks, there is.
Oh, okay.
For example, and I'm glad you brought it up. This is something you need to discuss with your accountant. So Christine owns the camera equipment. I don't know what the depreciation rate is on that. I mean, it sounds like you've got some equipment, after a year, it's obsolete.
Could be.
Could be.
Yeah.
Okay. Help me to remember, I'm going to talk about obsolescence in a minute. So you need to talk with your accountant and say, how quickly do I depreciate this stuff? And the first thing he's going to say is, well, how long do you use it? Because if you use the camera if you use the $500 camera and it's obsolete after a year, all of that becomes expense. Why? Because you've used it all up. See what I mean? If you've got a vehicle, on the other hand, that you're going to use for 5 years, you're going to recognize the expense over 5 years. You tie the expense of using the asset to the revenue that you used to create it. That's our matching principle, revenue expense. In this case, depreciation on the camera, revenue I created with the camera. Revenue with the camera, depreciation, expense on the camera. See what I mean? Which is why you want to have a depreciation expense account for each asset. Here's what I mean. I go to my chart of accounts. Remember that expenses are all the way at the bottom.
So if you plan on being in business for, say, 5 years, and you buy all your assets up front, you should depreciate them 20% each year?
The depreciation should be based on not how long you're in business, but how long the asset is usable either by you or someone else. So if you buy a truck that has a life of 5 years, but you only plan on being in business 3 years, at the end of 3 years, it's not fully depreciated, it has some value. So the assumption is you'd end up selling it, and it would still have value to someone else, and they would depreciate it.
So how do you determine how long an asset has value?
There's two ways. It's like I was saying with Christine, some of it's intuitive because you're in the business. More broadly, I would ask an accountant. For example, vehicles are normally depreciated over 5 years. But anybody use AAA, the greatest invention in the whole world? I had an exciting experience with a car. I had a transmission fall out on my car on an exit ramp off of a highway. I wouldn't recommend that. It was very exciting. It makes a loud noise. So I'm in the AAA truck. The guy's towing me, and I go, how many miles do you put on these trucks? He told me they put 300,000 miles on those trucks they use for AAA. So there's an asset that's really unusual because they're using those trucks a lot. But standard is 5 years for a vehicle, a year for a computer. So there are some standards if you don't know. Real quick before the break, let's recognize some depreciation expense. And normally there would be a standard account, and I don't see one, so I'm going to make one up. A lot of expense accounts. So I'm going to go all the way up to the top, and I'm going to hit Add New. Type of account, it's going to be an expense. So again, I have to slide to the bottom. What kind of expense? Well, since it doesn't show me, I can always hit other. On this basic version, it may not, yeah, I think I've got it. I'm going to call it, it really doesn't matter because it doesn't show up on here. I'm just going to say repair, what was that, repair and maintenance? That one, doesn't really matter. I'm going to call it depreciation. We know it's an expense account, it's going to get in the right place. And we're going to call it further depreciation on the camera. Again, I want to label a depreciation account for each asset. Okay? Expense, depreciation on specifically on the camera, save. Again, I'm only in one period, but I'm going to say that some time has passed and then I'm going to recognize $10 of depreciation. The number isn't as important as the concept. Now, unfortunately, this is one of the goofy accounts that you have to use in accounting. And for those of you in the audience who are going to have fixed assets, this is a little goofy. And I'm going to have to add new. Here's why it's goofy. We've got our camera account. And it's got $500 in it. And now I need to recognize depreciation. And a camera is an asset account. I just mentioned that I'm going to have depreciation expense because I've got to expense the value of the asset while I use it. So I increase the asset to buy the camera. Now I'm increasing an expense by $10. And I just set up an account. The other side of that entry is going to be a goofy account, but you need to know it for those of you who are going to have fixed assets called accumulated depreciation, which is basically a parking spot to keep track of your depreciation. I'm going to have to just, because they don't have a accumulated depreciation account built in, I'm just going to make one. And it's not going to be perfect, but it will get the point across. So I'm going to create a oh, they do have it. I mean, they made me a liar. There's accumulated depreciation. All right? Save. Now, here's the goofy thing. Depreciation on the camera is down here, the $10. The accumulated depreciation gets credited. This is just a parking place, to recognize your depreciation. Because let me post the entry and then I'm going to pull it up and we're going to have to break here shortly, okay?
We actually have a question in regards to the journal entries that I thought maybe we'd pose to you right now. There's a couple people in the chat rooms asking if there's a simpler way to do these journal entries or an alternate to doing the journal entries. And Jesse L actually asked if there's like a step one of the basics for someone just beginning where something they can begin with and build on. If they felt like the journal entries were just a little too complicated for them, or is this really where they need to start?
Unfortunately, it's where you need to start.
Okay.
Now, I'll give you some exceptions. Because we've talked about this. If you're doing a sale, it's easier for you to go to sales and create an invoice. The journal entry will post automatically for a sale.
Okay.
If it's an expense and you want to set up a payable, you can click on expense. So there are some ways to get around some transactions by going to this section. However, sometimes you just got to post these journal entries, and I understand it's Greek to a lot of people who are just starting the class. Okay?
Is there anything that you'd recommend for them to do? Let's say if they're planning on purchasing this course, is there anything that they can do to prepare themselves if they're kind of not quite there yet, that they can read up on or do something and then watch this course?
You can watch, that's a good question. You can watch tutorials on QuickBooks.
Great.
You can go to Intuit's QuickBooks site and they have great stuff on how to do this stuff.
Perfect, thank you.
Great stuff on how to do this stuff. That doesn't make sense. All right, before we wrap up, I just did this entry to recognize depreciation and park it here. Let's see where it turned up, and then I got to make one more point. I'm going to go to balance sheet. There's my accumulated depreciation. Do you see how I have camera that is an asset with a positive number, and I have accumulated depreciation that is a subtraction? Okay? So it did get posted. It's in the balance sheet. If I look at fixed assets, the accumulated depreciation got posted. And again, I named it just accumulated depreciation. I need to change the name of that to accumulated depreciation for camera. To be specific, I didn't do it. I broke my own rule. One more point. It gets back to the point of the guy buying the pizzeria or buying a photography store. So here's the assets section. We have a camera. We have accumulated depreciation on that camera. $10. I'm going to abbreviate accumulated depreciation. When I take the difference between those two numbers, not necessarily that it's going to be in QuickBooks, that is called the book value of the camera. Or in other words, the true value, what's left. And then I think I had a question. Give me just 1 second. That's the true value because that's what's the usable value that's left. Okay? Josh?
Isn't accumulated depreciation going to be the depreciation from all the different assets, and then it would balance out because it would have depreciation expense camera? So isn't this correct?
Yeah. So let me find I'm not showing you the depreciation expense. Let me go back. What you see on the screen is two of the three numbers. You see camera and you see accumulated depreciation, but you don't see depreciation expense. So let me just jump to that quickly. Okay? Report, profit and loss, expenses, there's your depreciation on the camera. So that shows up in an income statement. These are in the balance sheet, that's in an income statement because it's an expense. Okay?
Is that assuming a 50-year depreciation?
Yeah, I just picked $10.
Okay.
Which,
so then you would just depreciate it until you sell or you're at zero.
Right.
Okay.
Okay. So what we will do in the next segment is spend more time on QuickBooks generally and start adding on some things that you would typically do, like paying bills, invoicing, which we haven't covered, and dealing with bank accounts. So that's what we're going to do in the next segment.
Terrific, terrific. Well, it is that time that we need to take our 45-minute break for a little lunch and rest. But before we do, we want to share one of the comments that came in over the internet during this segment. Rogers Pro Photo said, "I'm so glad that Ken Boyd is going over safety. I'm starting a photography business, and this is giving me the confidence to take that leap into building my business. Thank you."
Yeah,
Good. That's great.
That's a great comment. And we do know a lot of you out there either already have your own small businesses or you're starting them up, as that quote indicated. And a lot of them are in the creative fields, a lot of photographers out there. And we know that accounting and finances may be the last thing you want to do for your business. It's not easy for everyone. It can be very intimidating. But I think as we saw in this last segment, it's vitally important to your business. And it's really important to separate the personal from the professional. I think that kind of gives your business a sense of legitimacy, and it's going to help you get more customers if you have your finances in order. So thankfully, we've had Ken here to help us do just that. And the best way to do that is to purchase the course so you can have access to this. You know, it is tax time. Over the next couple of months, people are going to need to be getting their finances in order.
I've been worried about mine, so it's
we
perfect
all are.
timing.
It affects us all. So now is a great time to make sure you're ready for taxes, and you'll have the course to refer back to when you need it. So as we've been saying, it is $149 for this course typically for all 3 days worth of information. But if you do buy it now while we're live, you can get it for $99. And that's really a fantastic deal, and it's going to help you become just more confident about your finances and help you take your business to the next level. Treat it more of a professional thing, less of a hobby, and turn it into real income. So think about it as we go to break, and click that buy button right there to have access to that course whenever you need it. And we will be back in 45 minutes.
What's the play?
We're in way over our heads!
I can't figure this out.
With 35 years of experience,
Welcome back from break. If you're just joining us, we're entering into the third segment of day 2 of Small Business Finance Basics, QuickBooks, and Beyond with the amazing Ken Boyd. We had our segment last segment. We were talking about making sure we protect ourselves, separating our personal finances from our business finances. And this segment, what are we going to get into?
We're going to try to go back and do more on the day-to-day transactions that you make in QuickBooks, like paying your bills, receiving payments, and bank account detail.
Terrific. And I know that all of our Creative Live participants online, this is stuff that they really can use, and they're very excited to use it. And we've got some entrepreneurs in our live audience right here as well. And I just wanted to give a little shout out to Candace. She has a skincare line that is pretty amazing, and she actually gave us some little samples that we're gonna get to try.
Awesome.
So I'm very excited about it, and I'm excited for her company. So I'll let you know tomorrow how I like it, but I'm sure it's great. We just wanted to encourage everybody also for any kind of participation that you'd like to do via social media. We encourage any tweets out to #BoydLive with Creative Live as well, at Creative Live. So with that, we'll see you in the chat rooms, and I'll let you take it away.
Thank you.
Thanks.
Thanks, guys. Where we left off with is a nice tie-in to the next segment, which again is some of the day-to-day stuff that you're going to do when you're in QuickBooks. And I'm going to make sure my phone's off. It's my paranoia. Okay. The first slide, paying bills, receiving payments, which we have touched on. Yes, sir.
Before we move to the next segment, I had a question on the previous one about the sole proprietor limited liability situation. Does that mean you should keep your cash account there kind of low in case something were to happen? Or if you expect an incident is coming up down the road, you just empty everything out? How does that work? Can you...
That's a really valid question. So let's go through a scenario. Let's say that you have a $10,000 bank account balance and somebody slips on the ice and falls outside of your pizzeria. And now you're concerned that there's some legal liability. If a business owner were to move assets out of the business, whether it's cash or anything, in a legal matter, a person seeing that you did that would probably think it was intentional and those assets would be included in the litigation. I'd talk to an attorney, but that's what I think would be suspected.
So should you keep them low as you can throughout?
I think the idea is you maintain whatever cash you need to run your business, which is a segment we're going to cover tomorrow, and work with an attorney, work with an accountant to protect yourself. In other words, I would not want a cash balance to be so low that you can't run your business. And I've seen people in that situation.
Well, then to follow up on that question, can you have too much cash?
Yes, you can. Let's talk about that for a second, because this is a natural progression into a segment we're going to do tomorrow on cash. The idea would be that the cash that you have in your business, you're using. And by using it, I mean you're using it for payroll, to buy inventory, to buy equipment, whatever. If you have too much cash in your business that you're not using, there's not some utility to it, there's no point in having it. For example, if you had a business with $50,000 and you're only using $20,000 month to month, and we're going to talk more about this in a minute, tomorrow. That $50,000 came from a source. Now, it was either you putting money in the business, or an investor coming in, or a lender. Well, there's no use bringing that business in and having somebody have a claim on that asset, in this case cash, unless you need it. So in corporate world, when you look at performance of a company, they're very big on how are you using your assets. And if you're not using them effectively, why do you need our cash at all? Might say, an investor might say. Okay? Anything else before I go? Go. Huh?
Just to follow up on his question, that's actually, like for my business, that's why I have general liability insurance. So that takes me out of like living in fear that if someone trips over my camera bag while I'm doing a wedding, you know, I have to have my accounts low and I can't, you know, I'm in business to make money. So I don't want to always have a super low account. I don't want to live like in fear that someone's going to sue me. So I just have my insurance and I can be a sole proprietor and that kind of takes care of it for me.
Right, and as a matter of fact, I'm glad you brought that up because Christine and I had a conversation about the break about insurance and whether in my example, when the money was stolen from this tree service company, insurance would have covered that. It's been so long I don't remember if he had liability insurance. But certainly a message to everyone is when you're having a conversation with an attorney about setting up your business, you need to have an, oh, by the way, what about insuring against theft, things like that, which would protect from that. Yeah, exactly. So those were all good points because it's good that we brought that up before we got away from this subject. Anything else? Okay. One of the big focuses that I have, again, is to do two things. Have you create a system and have you get comfortable enough with the system that when you have more transactions that it's not overwhelming. Have a system and have enough experience with the system that it's not overwhelming. One of the things you need to have in place in an operations manual is all the systems you have for your accounting. So this segment is kind of nuts and bolts stuff that we haven't covered, and I'm going to go into detail on more transactions than we've covered so far. We talked about T accounts already, and in fact, we've seen 4 or 5 examples on the flip chart and in QuickBooks how we do T accounts. We saw posting to balance sheet accounts. I'm going to go on and do an extra step, and it's the first thing I'm going to do of how these income statement accounts get closed at the end of the year. Remember when I mentioned that? I'm going to do that first. Capital accounts versus common or common stock, and then handling payroll. So again, if you're concerned, and we had an account on Twitter say, well, you know, my anxiety level about running my business is getting a little bit lower, the way to solidify that is to go through more transactions that you'll typically do, understand how to do them. Now, another thing about this course generally, because this relates to when I teach people online. I find that people online learn 2 ways. First of all, you've got to give them good graphics and pictures, which is why I started using the flip chart today, why we're using multiple things. And the other thing is, it's very likely that you'll have to go back over this ground again. And I'm not saying that everybody in the free world should buy the course, but whether it's this course or something else, you need the review. You need the review, particularly in accounting. Accounting is about repetition. Repetition. Okay? So, if you walk away from this course and you're like, I have no idea what he was talking about, if you go back in and do the repetition, it'll help. Just as an example, you may want to watch this video again and get out a piece of paper while I'm going through it and do those T accounts while I'm talking about them. And then you think, oh, okay, I kind of get it. If you physically do what I was doing on the whiteboard before now and for the rest of the course, watch it again and do it yourself, you might find that it helps you. A lot of times when I tutor online, I've got an Excel document that I'm going through, and I tell my students at the end, I'm going to send you the Excel document. Go through it again on your own. Repetition. Get the hang of it. Okay? First thing I want to talk about is closing accounts, which is not in my slide deck. Not that you need to do this. This is not something you need to do. This is something QuickBooks will do for you. Closing accounts at the end of the month. So, I mentioned before in the course that income statement accounts all get adjusted to zero at the end of a month. We start over at the beginning of the next month, right? New revenue. This is the, the blessing and the curse of being an entrepreneur. Every month starts at zero. Well, I wonder how I'm going to make a living this month. Now, you guys get clients, you get a reputation, and it's really not like that. But it's a good analogy to explain that revenue and expenses, we start over every month. They all go to zero. And the question is, where does all that activity go? All right? I am not going to do this in QuickBooks because I don't want to close a month in QuickBooks because I need the data. If I closed it in QuickBooks, I couldn't go back. Okay? So, and this is a good point for those of you out there. Once you close out a month in QuickBooks, that is, once you do what I'm going to do on the screen here in a minute, it's difficult to go back into that month because it's considered, the book is closed. So if it's February 2nd and you are going to click a button in QuickBooks to close the books and zero out all the income and the expenses, without going into too much detail, it's difficult to go back in and undo it. So make sure that before you hit the button to close a month, that you've got all the activity listed. Now, if you make a mistake, you can make a journal entry and fix it, but you're better off to make a clean break. All right? What I'm going to assume to begin with is that I have balances in my revenue and expense accounts. It's January 30th. My revenue account, we credit to increased revenue, has a balance of $1,000 for the month. I have a whole bunch of different expenses. And I add them up, and I think it's $220. Okay? If I go into QuickBooks right now, I'm not going to, but if I did, I've got a series of revenue and expense transactions for the month of January in the system. You should know that income statements, an income statement is a temporary account, meaning that the balance doesn't carry forward month to month to month. Income statements are temporary accounts. We zero them out every month. How do we zero them out? Here's how we do it. We increase equity accounts by crediting. I'm going to assume that it's the first month my business is open, and my equity balance is zero on 1/1/2014. Okay? What I do is I move the revenue and I move the expense over to this category. All right? Here's what I do. Number one, I debit to reduce the revenue, and I move it over here. So this has a balance of zero. Debit to reduce it, put it over here. I credit, number two, to reduce all the expense. So that is now a zero balance, and I move that over here. I credit to reduce the expense, move it over here, that's entry number two. I debit to reduce the revenue, put it over here, that's entry number one. Okay? The net effect of that is I have a $780 profit that's sitting in my equity. It increases my equity. Let me do it one more time. I debit to reduce the revenue and I move it over here. I credit to reduce the expense and I move it over here. When I take the net difference between the two, it's $780 and it increases my equity. Now I have a choice of what I do with this equity, this increase due to the profit. I could take the profit out of my business or I could leave it in. So on January 30th, all these accounts get adjusted to zero. The balance sheet accounts continue forever, okay? A good example I use, General Electric is one of just a few companies left that are traded in the stock exchange that have been in business for over 100 years. If you looked at General Electric's equity section of their balance sheet today, it would be the sum of 100 years worth of profit less the sum of 100 years of dividends paid. Their equity, General Electric, would be the sum of 100 years of equity increasing less 100 years of dividends decreasing. See what I mean? The account goes on forever. The balance sheet accounts go on forever. Okay? So what we just did is that we talked about closing the accounts at the end of the month. We're only closing the income statement, the revenue and expense accounts, because they're temporary. We do that by debiting to get rid of the revenue and move it over here. We credit to get rid of the expense, move it over here. Take the net difference, that's our profit. I know that's a lot to throw at you. That is something that QuickBooks does automatically for you when you click a button at the end of the month. Okay? Questions on that? Mm-hmm.
So in QuickBooks, is that under a tab that says closing accounts?
Mm-hmm. I'll show, when we go into QuickBooks, I'll make sure and show it to you, and please remind me if I don't. There's a month-end close, essentially. It's a little different depending on the version of QuickBooks. Other questions on that? Okay? Again, a little pushing the envelope and the accounting you need to know, but what I don't want to happen is, I do not want a situation where you do not close your accounts, because what's going to happen? If you leave the revenue and expense in here and start working in February, your revenue shouldn't be in there and your expense shouldn't be in there because this is January. So what I'm saying is you have to close the books, or else you're accumulating a bunch of stuff that doesn't belong in February. Okay? QuickBooks does it automatically for you. Okay. Mm-hmm.
Closing the books, I just saw it come through. JD Peters wanted to know if you have to close out at the end of the month, or can you do it mid the next month? Can you wait to do it mid the next month, even if you're doing it once a month?
That's tricky, okay? Let's say it's February 10th. Mm-hmm. What I would prefer somebody do is close out on the last day of the month, or if you're not going to close on the last day of the month, don't do any transactions in February until you close. Okay? The problem with waiting till mid-month is I wouldn't want anything from February 1st to 15th to be in there because it's going to get skewed and it might get in the wrong month. So it's a good point. Don't post anything for February until you close January.
Thank you.
Mm-hmm. Anything else? Okay. This we've covered, so I'm going to keep going. But I'm going to put a finer point on posting entries. Now, I did this on the flip chart at the beginning of the day, sort of. Sort of. But we're going to make a finer point here. The magic formula, this is the E equals MC squared of accounting. Assets equal liabilities plus equity. Debits on the left, credits on the right. Now, intuitively, I think you've figured this out because we've had enough examples, but just in case, how you post an account differs depending on the type of account. Okay? Let me write down, or I've got written down actually on here what the differences are. Asset accounts get increased by debiting. So what you've seen me do is, every time I increase cash, it's a debit. So you can make a little note on this. This is a different graphic than what I have here, but you can make a note on it of this if you want. Assets get increased by debiting. Okay? Next bullet point on the slide. Client pays $1,000 cash for photography. We debit to increase an asset $1,000. We credit to increase sales, which brings up something new. We just saw that equity is made up of revenue and expenses. And we see that that sale is created, which means that a sale gets posted or increased by crediting. Okay? Next slide. Liability accounts get increased by crediting. In fact, liability and equity, in case I didn't say it on the slide. Example, we purchase photography equipment on credit, which we really haven't done much with. We debit equipment, we increase an asset account, but we credit an account called accounts payable. We increase a liability account, accounts payable. You almost have to memorize, make a note for yourself on what's going on here. And I don't have it laid out exactly this way on my stack of slides. Okay? Hopefully, I can tie this formula into the debit and credit for you to help you make this clear. Assets get increased by debiting on the left-hand side of the equal sign. Liability and equity gets increased by crediting on the right-hand side of the equal sign. So, another way of saying it is, I've got asset increases on the debit. I've got liability and equity increases on the credit side. Why does that matter? Because it does two things. This equal sign remains in balance, and the debits equal the credits. One more time. The assets equal liabilities plus equity. This formula holds true, number one. Debits equal credits, number two. Okay? Even when I teach undergraduates or MBA students who've never seen accounting before, you just have to about memorize this until you start getting the hang of it by doing transactions. Okay? So if you're at home and you see this, make a note of that. Make a note of that. It is not in my slide deck exactly like that. Okay? Questions on that? I've done it before, but not put that fine a point on it. Capital accounts. Remember, and this is important and worth showing a little bit different way. Because remember, there's a difference between how common stockholders, I'll get it in just a sec. There we go. There's a difference between how equity is handled between sole proprietorships and partnerships on the one hand. They call it capital. Equity equals the sum of the capital accounts. For sole proprietorships and partnerships, equity is the sum of the capital. Bob's capital, Jim's capital, Joe's capital equals total capital. Okay? So, One more time, it's worth it. And it clears up a question that was asked in the last segment. Let's talk about the total capital of the business. Total. The total capital of the business is made up of Bob and Sue. They each have their own capital account built into QuickBooks. I'm going to use C for capital. Bob's C, Sue's C. Okay? So we can envision that. If you got 5 owners, 5 capital accounts. Sue puts $1,000 cash in the business. We would increase cash by debiting. She gets $1,000 because she contributed capital, investment, cash. Okay? The total company equity also increases because this is for Sue. All right? Bob puts in a piece of equipment that's $500. We credit his capital because he invested equipment. I'm going to abbreviate. The capital for the whole company goes up for the equipment. And by the way, we would debit an account called equipment. That would be the other side of this transaction. We would debit cash for this. So far, we have capital of $1,500. Okay? We haven't really talked about this. We haven't put a fine point on this. What about a withdrawal? Which we really haven't talked about. Well, what I did talk about is it could be called anything. You could call it salary. You could call it a return of capital. It really doesn't matter. If you are taking dollars out of the business, we call it a withdrawal. Let's just keep it that simple. Is it a loan? Is it salary? Let's just keep it simple. It's a withdrawal. Let's say that Sue takes out $700. I'm going to abbreviate the word withdraw. That's going to reduce the capital of the whole company. Sue, WD for withdrawal. All right? The point I'm trying to make is that in a QuickBooks system, the total capital is going to be the sum of these smaller accounts. Okay? Increased by contributions, decreased by withdrawals. One more thing. And this gets to the conversation that we had right at the end of the last segment. Profit. We just saw that profit increases capital. Say it's $3,000. Profit. Based on a partnership agreement, that profit will get credited to these 2 sub-accounts. So in other words, if this one adds up to $3,000 and they agree to split profit evenly, depending on the partnership agreement, we get a credit to Bob's account, $1,500. We get a credit to Sue's account, $1,500 in the sub-accounts, and they add up to $3,000. All right? Now, careful. This is crediting profit. This is not taking money out. Okay? It's sitting in their accounts. This is a withdrawal, the $700. This is just increasing the balance of the capital account. It's not a withdrawal. Okay? That's a lot going on that screen. Questions on that? Okay? Moving along. We just talked about capital Now let's move to another screen and we're going to talk about common stock. The last point on this screen, increased by capital contributions. We saw that. It could be cash or equipment. Decreased by a payment to an owner. Sue took out $700. Or if you have a company loss. The profit increased the account by crediting. If I had a loss, it would be a debit. And it would reduce these because if they take 50% of the profit and share it, they get 50% of the loss assigned to them. Okay? I said repeatedly for the benefit of the audience that in many cases, if you want to grow a big business, you've just about got to set up a corporation. You get the sticks there at the bottom. There we go. Why? Because the corporation allows you to easily raise a lot of money by issuing a lot of stock. Let's talk about that. First of all, in the slides. Bob invests $1,500 cash into image photography. We've gone through this one. Cash goes in the business. We saw it in the C account. Bob gets a credit to his account. Off you run. Well, what about common stock? Again, this is a little more accounting than, this is pushing the envelope in the amount of accounting that I think you need to know. But if you're going to go out there and grow a business and you're thinking about getting other owners and being a corporation, I have to go through this. It's important to go through it. Okay? Remember that there are no capital accounts if you're a corporation. Let me say that again. There are no capital accounts if you're a corporation. Instead of Bob and Sue having capital accounts, Bob and Sue just own stock. Okay? Bob and Sue just own stock. Let's look at the slide again. We've got 3 accounts that are in equity if you're a corporation. Real basic. Issuing stock. Now again, I'm not going to do it in the QuickBooks because that is a sole proprietor, but we need to talk about this for those of you who want to grow a business to be a corporation. Do my T accounts. I'm abbreviating a phrase called additional paid-in capital that's on the screen here. You see that common stock and additional paid-in capital get increased by issuing stock. Now, I'm going to simplify something that's tricky. Somebody buys $10,000 worth of stock in your company. Some of it is going to get assigned to common stock based on what's called the par value of the stock, which is just an accounting notation. So I'm going to say in my example, and again, this is pushing the envelope on accounting stuff, but I got to mention it. Let's say that this is 10,000 shares. Oh, no, sorry. It's 1,000 shares of $1 par stock, and it's just an accounting entry, and it's annoying, but I have to cover it. The par amount times the number of shares, which equals 1,000, that's the amount that gets posted to the common stock. The other $9,000 we call additional paid-in capital. So 1,000 plus 9,000 is 10,000. Okay? What you need to know is that the credits get posted to these accounts, and this is all equity. That's all equity. Again, pushing the envelope, but I need to know that, and you also need to know it, so that if you're 2 years down the road and you're looking at merging with somebody, or you're looking about getting stock in exchange for doing something, down the road, you need to have, maybe you keep this in the back of your mind. Okay? Issuing, yes, ma'am.
Don't you have to be careful when you're issuing stock? Because can't your company accidentally go public when you don't intend it to?
Let me explain that. There's a couple steps there, and it's worth talking about. Any questions on this before I leave it?
I have one question of, does this go on top of what we were just looking at with withdrawals, or does it negate that?
Let me go one more step.
Okay.
Okay, what I talked about before. This is capital sole proprietor partnership. Okay? End of story, the end. Now, this is corporation issuing stock. Okay? That's the difference. How do these shareholders get money back? We saw an example earlier today about a dividend. You pay a dividend out of earnings, which reduces your equity. Okay, end of that story. Issuing stock increases your equity, you pay out a dividend, it reduces it. Okay? That's the difference. Now let me talk about that going public thing. Because there's a misconception here, and especially for those of you who are out there trying to raise money, let me explain this misconception. You can be a corporation. Have a corporation. You can issue stock in that corporation. I'm going to call it Valentine. Valentine flowers. Okay? You can issue stock in Valentine flowers. Sure. However, there's a delineation, there's a separate. You will most likely start off with something that's called a private placement. Did anybody go out? Probably not, because I'm a huge geek and you're not. But before Facebook went public, right before, somebody had created a site called Who Owns Facebook? Has anybody ever looked at it? It's whoownsfacebook.com. I don't know if it's still out there. Because I was interested in seeing who the big investors were in Facebook, and who the early investors were, and surprisingly, maybe it is surprisingly, it was to me, Bono from U2 is part of a partnership that was a very early investor in Facebook that owns quite a bit of Facebook. So if you were concerned that Bono was not making enough money touring, let me allay your fears. He's doing okay. Those guys are actually my age. U2, is anybody a U2 fan? Remember the live album Under a Blood Red Sky at Red Rocks in Colorado? They came out when I was in college. I remember I was in a college fraternity, and MTV started the fall I went to college in '81. And this is like '82, and I remember walking and looking in somebody's door, and it's that Red Rocks concert, and it was just like, who are these guys? It was U2. Okay, Bono's partnership bought Facebook as a private placement, which means you are selling to a limited number of people. It varies by state. They have a certain amount of investment experience. They've got some net worth and some assets, and essentially they can afford to lose money and take more risk than the general public. It varies by state. You usually register this by state. So Facebook, all of these companies that you know that have gone public recently started off probably as a private placement. There are stockholders, but it's not the general public. Okay? Then you do an initial public offering, an IPO. Now, Twitter's a good example. Twitter only sold 10, 15% of the company to the public. 85, 90% of them still owned by the guys who bought it on private placement, guys and gals. Initial public offering means that you're selling it to the general public. Anybody who can fog a mirror can buy the stock. There is no requirement for experience level. There is no requirement for net worth, annual income. Like a private placement, depending on your state, anybody can buy it. Now, the problem is that you have to create, I'm going this step because this applies to those of you who are eventually going to try to do an offering. You have to create a prospectus, and you have to register the prospectus with the SEC, the Securities and Exchange Commission. What I'm getting at is that is a lot more disclosure than when you do a private placement where you have something called a registration statement, which is a lot more limited. Okay, now let me bring this back to this audience. I mentioned step one. If you want to raise a good amount, I almost wanted to ways. I sound like Barbara Walters there. Want to ways? If you want to raise a lot of money, issuing stock, corporation is the best way to go because you can issue just about an unlimited amount of stock. How do I do it? Well, first you're going to do a private placement. Well, why? You go to a limited number of people who have more experience and net worth because you have less of a track record. Okay? So, angel investors, venture capital folk are in this category. Then you can sell an initial public offering to the general public. You got to fill out a prospectus. Did anybody read the Facebook prospectus? Oh my gosh, that sounds incredibly boring. I actually read a fair amount of it when they went public last summer. I don't remember. The difficult thing about a prospectus is now you've got to show your cards. I mentioned in a prior segment that Twitter, maybe I didn't mention it. If you look at Twitter's prospectus, they say they're not going to be profitable till 2015, 16. They had to disclose that. You've basically got to disclose all your cards. Why? Because the general public's buying the stock, and they're less sophisticated, and they may not be able to afford the risk. So you need huge, huge amounts of disclosure here. Huge disclosure here. Nah, not so much. Okay? Is that all right? Okay. One more thing, I'm going to tie net income to retained earnings, and then I'm going to go, for Ben's benefit, I'm going to go into QuickBooks in about 5 minutes. Please. This is the last of the hard T account stuff I gotta present to you. Last little hitch, last little hurdle. All right? Bear with me. Because here's the problem. If I don't show this to you, this will happen in QuickBooks, and you'll be asking your accountant, what, huh? What happened? Where did the numbers go? Okay? This is my bias with when I used to, when I do some finance tutoring now. Did everybody use like a TI calculator in college if you did math? Okay? I'm still using present and future value tables for calculating present and future value that you can find on the web. Why? Because I can show somebody how the number, where the number was taken from rather than them just pulling it up on a computer. All right? In the same way, if I don't do this, it's going to happen in QuickBooks and you're going to, what? Where did the number go? Why is this a zero? What? That's why I have to do this. Because 6 months from now, you're going to have this happen in your business and you're going to thank me. You're going to say, so glad Ken told me how to do it. I'm going to go back and watch this video again. Over and over again. Maybe not that much, but you know what I'm getting at now. Okay. Once again, you've got revenue. You've got expenses. And we talked about how they end up in equity. We're going to zero out the revenue of a $1,000 debit, which reduces the account. There's a reason why I'm doing this again. Bear with me. It goes over here. Revenue. There's a talk radio guy in St. Louis who does sports talk radio, and he was always yelling at people, have a point. So I do have a point. I credit to reduce the expenses. I move the expenses over here. We saw that. And what I said was that this is your profit. Now I want to add on one more thing, and that relates to the slide, retained earnings, which gets increased by your profit, your net income, I'm using those terms interchangeably, and reduced by a dividend. This is the thing I'm going to put on the screen now. And this is happening in your QuickBooks. Retained earnings is an equity account. One thing that increases this profit number that's an equity, it's actually inside retained earnings. I just called it equity to keep it simpler. Okay? If you choose to pay a dividend, it is a debit that reduces retained earnings. Okay? One real difficult area in QuickBooks is the equity section of QuickBooks. When I pull it up, I'll show you what I mean. People get the equity section. It doesn't matter if you're a sole proprietor or a partnership doing capital, or whether you're a corporation doing common stock. People get it messed up, which is why I'm covering this ground. All right? That all right? I am going to go into QuickBooks. I could just tear it. Why don't I just tear it? Brian, is it okay if I set this on the ground, or is that?
Yeah, I'll take it.
Okay. I'll flip them from now on. Thank you. All right. I'm going to reduce this, and there's our magical QuickBooks. Okay. I talked about in this segment that we're going to touch on paying bills, and I'm going to go to that next. We talked about capital accounts, we talked about retained earnings. Okay? Ben, can I go, sorry. Can I go back to the slides for just a minute? Sorry about that.
No worries, Ken.
Oh, there, yeah, got it. Thank you very much. Thank you. Payroll. I do have a slide on this I want to cover. I highly recommend that you use a payroll company for payroll, even if you have one employee, and I think I've mentioned this before. The reason is that the payroll company takes liability to make sure that the withholdings are correct, because there are penalties if it's wrong, okay? There are penalties if it's wrong. I'm not an attorney, I don't run a payroll company, but generally they will take liability for getting these calculations correct. I'm going to add on, I'm going to comment at the bottom and then talk about the rest of the slide. Employee versus independent contractor. This is big for many people in this audience. And it's something that you can easily get off track on as a business owner. One of my producers mentioned this a month ago. Make sure you talk about this. And I completely forgot until I was on the plane in heavy turbulence, and I thought, oh, I need to do this. I was on a plane I was landing in a plane at O'Hare in very heavy, right before a huge heavy storm. And we're getting off the plane. And it was one of those planes where they have to take off the baggage manually. It was a small plane. And so we're deplaning and we're on the ramp, and the guy says, you know, I want to apologize but we have lightning in the area. And we can't, for safety reasons, have our baggage people take off the luggage yet. And a guy beside me goes, you know what? This never happens to me on Delta. Really? So the skies are always clear when you fly Delta, but on this airline, God doesn't want this airline to, take your, what? I thought that was unnecessary. This never happens to me on Delta. I couldn't believe the guy. And the agent, true professional, just apologized. Employee versus independent contractor. I've met a lot of people here at Creative Live who've had careers as independent contractors, freelancers, okay? Let's look at this in the context of you and your business. It's very likely that the first person you hire to help you, and we've already had this discussion, I think, is going to be an independent contractor, right? Probably not a full-time employee at the beginning. You have to be careful that the person you think is an independent contractor is actually treated as an employee. The person you think is an independent contractor is actually operating as an employee. There is an IRS publication on this. It used to be publication 15. If you go to irs.gov and you Google, you're already there. If you're on that site and you search, what I meant to say, employee versus independent contractor, there will be an IRS publication that comes up. I would talk to an accountant about it first, but you can pull the publication if you want. It used to be publication 15. Okay? Why is this a problem? A couple reasons. Well, let me back up. The IRS publication dictates who is an employee and who is not an employee. I'm going to put a question mark. I think that's it. Essentially, well, how do you tell the difference? Essentially, if you, quote, control enough of the actions of the person who's working for you, quote unquote, they're an employee. They're not an independent contractor. And there's a laundry list in the publication of who is and isn't. And I got to tell you, accounting friends of mine they are very concerned about getting this right for clients. So your accountant, if they're good, they're going to take a lot of time asking you questions and really drilling down to find out if the person's really an employee. There's a couple reasons why, if they are an employee and you didn't think they were, there's a couple problems. Problem number one is how you document, how you compensate them. If they're an employee, they should be getting a W-2 that has withholdings on it. If you're an independent contractor like I am, you're getting 1099s. No withholding, independent contractor, required withholding employee. That's a big one. Okay? That's a big issue. So the first is the tax issue. The second is the legal issues. And again, and I'm not an attorney, but if that person is working on your behalf and they're really an employee versus an independent contractor, ask an attorney. There are legal issues that come up because you've got more liability for the actions of an employee than you do for an independent contractor. Because the theory, the concept of an independent contractor is this person's self-sufficient, they work on their own, they don't need a lot of supervision. Independent contractor don't need a lot of supervision, so they're kind of out there running on their own, I had a conference call this morning, and again, Ken, why are you so glad you're in San Francisco? Well, I had a conference call this morning with somebody in Hoboken, New York. Took her an hour and a half to get to work today. And somebody in Indianapolis, and it's like 10 degrees. And they're on the line and they think I'm in St. Louis because I did not have the heart to tell them. I'm in San Francisco. I didn't have the heart to tell them. But this is a good example of independent contractor. So I'm writing another book, and I won't bore you with what it is, but it's a dummies book. And the editors say to me on the line, well, you know, you've been through this process a couple of times, so we're going to kind of let you run more than we did at the beginning, because I need less supervision, and they're not controlling my activities like they were. So think about that. If you're running a film business and you've got somebody as an independent contractor, you need to talk to your accountant about, well, you know, what can this independent contractor do and not do? And you need to go down that road with your accountant, please, okay? You need to go down that road with your accountant. Is that okay? That was a big one I was asked to mention. Payroll. So now you've got somebody who is an employee. Why is payroll something that you need to contract out to somebody else? A lot of steps. There's got to be deductions from pay for tax withholdings. I'm going to do an example in QuickBooks in a minute. There's tax forms you got to send in, and there's also deposits. You've got to send in, most likely, federal tax deposits for your profit, state tax deposits, maybe, not for most people, but maybe state tax deposits for estimated payments. I mean, for payroll, maybe local, certainly federal and state, but maybe even local. In St. Louis, like I said, if you work in the city, there's a 1% earnings tax. Got to fill out a form for that. So there's there's withholdings, there's forms. The third bullet point, calculating benefits. And then we have the added issue starting in 2014, although it's been delayed, with Affordable Care Act. That's a big issue for friends of mine who are self-employed. I have two friends who own home health care businesses where they have lots and lots of employees doing home health care on an hourly basis. Are these people employees? Does the Affordable Care Act apply? Okay? Lot going on. Have a payroll company do it. What they will typically charge you is a dollar rate per employee every time they run payroll. So if you run payroll twice a month, they're going to charge you a rate for each employee. Now, one friend of mine who owns a home healthcare business, we were at a New Year's Eve party, and he made some comment that he had to, quote, run payroll, and I about dropped my Chardonnay on the ground and ran out of the room screaming, because he has 60 employees, and he is trying to do this himself with an employee. He is not using a payroll company. Big mistake. He's burning way too much time doing that. Better off having somebody else do it. It'll be the best money you ever spent. Please don't do it yourself, okay? Let me give you an example transaction on the board, and then I'm going to display it in QuickBooks, okay? My youngest was born January 8th of 2000. We missed a millennial baby by 7 days, and it was funny because we were at the New Year's Eve party at the same house, and there were 3 women who were all pregnant and they all had kids within like 5 days. We all missed millennial babies. Not by much. I won't tell you how big my third child was, because my wife will be here in a few hours and it's embarrassing. But she was big. Not she's big now, but she was big as a baby. All right, here we go. Payroll. You guys know this because we've all done, just about everybody's had a W-2 at some point. We've all looked at our W-2. So let's just make up a W-2 situation. You have gross pay of $1,000. Keep it simple. You have federal tax withholding, WH for withholding, $100. And you have net pay, $900. Okay? Real simple. One withholding. Okay? Let's think about how that actually debits and credits, okay? Cash We credit cash to reduce cash, right? So there's that part of the entry. Important point here. You earned 1,000, you were only paid 900. The question is, where did the other $100 go? Well, it's a federal tax withholding, and that is a liability if you're the employer, if you're the company. This number is here, and it's a liability. Another reason you need a payroll company. The payroll company will discipline you to segregate and send in these withholdings, okay? So you're not making the mistake of commingling tax withholdings with other cash and reconciling. Keep it easy. Have the payroll company take that money out and send it in for you with the form. Don't do it yourself, okay? So we have two credits. We need debits to equal credits. Salary expense. We debit $1,000 for the expense, which increases salary. Now, this is a trick, this is a hitch that people have trouble with. The salary expense to your business is the full amount, right? The only difference between the salary expense and the cash the employee gets is withholding. Your expense is the full amount. People get confused and they go, oh, I wrote him a check for $900, my expense is $900. No, your expense is for the whole thing, right? If you get that, that's great, but I've had people have trouble with that. Let me switch, if I can, Ben, to QuickBooks at this point. Or is it Brian? I'm not sure. Thank you very much. Okay. It's been asked several times, well, what about payroll? In this simple version of QuickBooks, there is not payroll, but if I can find it, I can get to that page. Here we go. Yeah, here we go. This is what I hit was I went to the circle and I said, I want to do recurring transactions. See the arrow? And I got this layout that shows you all three different kinds of the online system on a monthly. And I'm just going to tell you, this is my bias. Paying $40 a month for this software, that's a bargain. For what it does, I mean, I don't work for QuickBooks, but boy, that's pretty cheap. So you run down the list of things here on the support that each of the three types of software do. You can see that the far one does inventory tracking, that the far one on the right does budget and planning, okay? But what you're not seeing on here is the online version that does payroll. Let's look through it one more time. And if you guys see it, holler, but I don't think it's on here. But there's a way around it. Okay. No. Okay. So I want to use the online version of QuickBooks. I don't think I'm sophisticated enough where I have to use one of the versions that you download. I've only got one employee. I'm going to hire a payroll company to do this. You can do this on a small scale manually without having to have the payroll portion of QuickBooks. Here's what I mean. Again, I'm going to go to plus. I'm going to go to journal entry, which I know, and based on the comment that was online, not everybody is fond of using this screen, but for the payroll you do, because if I go to transactions, over here, there is not a segment here to do payroll. See what I mean? You can do invoices. I'll get to that in just a second. Okay. That's the one I'm going to use. So sales, expenses, registers. This section does not do payroll, and that's the next thing I was going to say. So what about employees? Okay? So going back to the home page, since there were a couple hitches here, I'm going to go to home. I'm going to go to employees. Now, need to pay employees, it says turn on payroll, which is an extra fee. So I'm not going to click that button. Okay? You could, and it's going to go out and you can buy more QuickBooks. Let's just see what happens if I do it. It may be an add-on you have to pay for. Oh, try it free. I'm not sure if I want to go this deep into this. So let me go back and tell you what I did. So we went to homepage employee, and I said, what about turning on payroll? And I got try it online for free. Now, there's a cost, obviously, if you go into this and decide to go past the 30-day program, and you can turn this stuff on. So let's click on see your, so look at your preferences at the bottom. I want to pay payroll taxes myself using their tax forms. I want payroll experts to handle my taxes for me. Let's just click on it. They recommend the full service payroll, okay? It's this much a month. So that's getting into it, QuickBooks payroll system in there. If you, though, just have one employee, and just to illustrate what goes on with your payroll, even if you're having them do it, let me illustrate it. Okay? So I've decided I've gone to employees. I've looked at turn on payroll. I look at my plan, and I say to myself, you know, I'm not going to start the QuickBooks Online payroll because all I'm going to do right now with one employee is just take the report that has this information from the payroll company and enter it myself. I'm also doing this selfishly because it shows you what's going on. The debits and credits in QuickBooks, which you need to see, rather than just relying on the payroll and having it posted to your account. All right? Let me go to home, get us back to where we need to be. So, I'm going to go to reports, and I'm going to go to the balance sheet, and I'm going to see how much cash I have today. And I'm going to put it through the end of February, because I did a transaction for the end of February, and I'm going to hit Run Report. And I've got $4,800. So I can pay this $1,000 payroll and post it with these numbers. That's why I looked. So, again, I'm not using the employee system. I'm just keeping it really generic, and I'm going to post this in QuickBooks using a journal entry. Journal entry. Just, again, to educate folks on the debit and credit part of this. The first thing I'm going to have is a salary expense. So I'm going to scroll down to expenses. I wonder if I have a salary expense category. I've got legal and professional fees, and this brings up a good point. If somebody is not an employee, if they are an independent contractor, you could post it under legal or professional fees. You're hiring a professional, you're paying them you're giving them a 1099. If it's payroll, it should be salary expense. So if it's independent contractor, you're paying your lawyer, you're paying your accountant, you're paying your whomever. That's not an employee, you can use legal and professional fees. Okay? I keep scrolling. There's a subcontractor account. Again, not an employee. Independent contractor, not an employee. So if you're Levi's and you're making blue jeans, and you subcontract out to a company to cut the denim and send it to you, so that you subcontract out cutting the denim, and then you get the denim and sew it and make the blue jeans, that's a subcontractor, that's not an employee. Okay? Subcontractor. Or Christine, if you're paying somebody to do editing work because you don't have time or whatever to do it yourself, that's a subcontractor. It's not an employee. Okay? All that being said, excuse me. Hey, Brian, could I get some more water whenever? Thank you. I'm going to create an expense account. This is kind of the most exciting part of the day, am I wrong? This is this is big. I'm going to create a new, thank you. I'm going to create a new account. It's going to be an expense. Expenses. I click on it. Now, QuickBooks is good because it gives you these subtitles underneath the category. Detailed type. Now, got to be careful. Is there a salary category? There's not. But there's some confusion because look, there's a cost of labor. I'm going to use that. Again, this type that you see in blue in the blue box, that does not affect your accounting directly. It's just categorizing expenses. It does not get to your financial statements. So if you're like me in this instance and you've got a type that doesn't exactly fit what you want to use, go ahead and use it because it's not going to affect the reports that get sent out. So I'm going to create salary expense. And again, I would avoid, if I click on this, I would avoid sub-accounts unless you really have to. Here's why. When you have sub-accounts and you see activity, so if I had salary expense and then I had 5 sub-accounts, that's going to show up as one long description on every transaction, and it gets a little unwieldy. So I would, wherever possible, just have individual accounts and not have a lot of sub-accounts. Now, under capital, if you want to have a sub-account for Bob's capital and Jill's capital, that's fine. But I would avoid using a lot of sub-accounts. Yes, ma'am.
So I want to tie like how much a particular employee is costing me because there's a salary and there's the cost of that employee's health care insurance, which like their salary may be that $1,000. Their health care for their family of 4 may be another $1,200, and there may be other costs associated with that employee. How am I tracking that within QuickBooks?
So what I could do is, rather than just having one withholding, I would have a withholding for federal tax, state tax, insurance premiums that they pay. Now let me make a distinction. Can you hold that just a minute because I want to talk about that. And
if you could add to that 401ks as well.
Okay. Can you hang on to that for just a minute? Because I need to come back to that. Okay? Let me finish the journal entry first. Because I have no shot at remembering that in 2 minutes. Okay? My expense was a debit. I debit to increase expenses $1,000. Federal tax withholding, it's a liability. Why? Because I'm obligated to send that tax deposit in. Okay? Do I have a liability account? I have sales taxes payable if I was collecting sales taxes. I have customer deposits, but I don't have any other liability accounts. So I'm going to create new liability. Current liability. Now you'll notice here that there's current and long-term. And let me just, while we're here, I need to define that. It comes up later in an exciting segment down the road. But anyway, for this class, current means less than or equal to 12 months. Current means less than or equal to 12 months. So that means that liability is going to be paid in 12 months or less. That's a current liability. Now, if you had a bank loan that had payments 3 or 4 years out, those are long-term liabilities which are here. You see the difference? Current, pay in less than a year. Long-term, more than a year. It's a current liability. You'll see, and this relates to Jackie's question, here's a whole bunch of payable accounts that relate to payroll. Federal income tax payable, payroll tax payable, which is a generic category, And this answers partly her question. Sales tax payable, state and local income tax, whole bunch of categories. I'm going to say it's federal income tax. I'm not going to create a sub-account, I'm not going to put it in a balance, and I'm going to hit save. Now, you'll notice something on QuickBooks too. Do you notice how I posted a $1,000 debit, and when I put in this account, it automatically posted a $1,000 credit, which I can change. That's to make debits equal credits. Now watch what happens. I'm going to put in $100. Okay? When I click on this line, $900 is going to automatically fill here when I pick an account. We paid him cash. Checking, the $900 automatically filled. Is everybody with me on this? Salary payable, $1,000, right there. Salary expense, $1,000. Tax withholding, $100, credit, second line. Paid out cash, $900, third line. Is everybody with me? Do debits equal credits at the bottom? Yes, they do. The most exciting thing for an accountant ever, post the entry. Let me show you where this appears in the reports, and then I'm going to go back to Jackie O's question, okay? Home report. I'd like to know where it appears on the reports. If you look at the board, I know salary expenses in the income statement where revenue and expenses are. This is a liability. That's in the balance sheet. Cash is in the balance sheet. You'll notice as we keep going, cash gets a whole bunch of activity, doesn't it? Grows and grows and grows and grows. Let's go to the balance sheet. What I should find is cash reduction, and I should find a federal withholding. There's my cash balance. It did go down. If I click on it, I get all the detail. And if I scroll to the bottom, sorry. I know it's in there. Where's that $900 check? There it is right there. Journal entry number 10, I have it highlighted in blue, $900 negative reduced cash. Okay? Transaction detail for checking. There's checking. I go back. Liabilities. You'll notice that it's divided, the liabilities section, into current liabilities, there's a subtotal, and total liabilities. If I put in a long-term liability here, it'll fill in. Right now, we only have current. Income tax payable, $100. I click on it. I go to a summary report, but again, it doesn't show me both sides of the transaction. Click on journal entry. Now, I'm going to make a change to this journal entry because I broke my own rule, which is I didn't put in a description. I'm going to say it's a $1,000 salary payment and federal tax withholding. I'm going to abbreviate withholding. And then I'm going to copy that same description down so that regardless of which of these numbers I look at, I'm going to see the same description. And then I'm going to hit save again. So I'm updating an existing journal entry. Okay? Let's go back. Report, profit and loss, which is what they call an income statement. There's my salary expense. Under expenses, $1,000. Click on it. I see the journal entry, and now I see the memo description, which is so important to put on every transaction. Journal entry. There it is. Okay? So what we just did was we took this transaction, we recorded salary expense, some withholding, and paid cash, like we did here. We found it on QuickBooks in the reports. Jackie, can you ask your question again?
I want you to track how much an individual employee is costing with the total of all their costs, salary, insurance premiums, etc. How do I do that on QuickBooks?
So
401k contributions
right.
that I'm matching, etc.
I'll do it on the board and then I'll show you where it'll be in QuickBooks. There's a couple ways to do it, and that's why I'm thinking. But let's just say an employee has accumulated over a year 2013 benefits. Because this is worth talking about, because this is another area of misconception. Insurance. I'm going to use EE for employee, and I'm going to use U for the owner. Okay? The portion that, and I'm going to do it in QuickBooks, in fact, the portion that of the insurance cost that the employee pays is simply withheld and sent in, right? Let's say they pay 100 and you as the employer pay 100. This is the employer's expense, what you pay. This is not an expense to the employer. That's just money you're withholding and sending in for them, right? Okay, I want to make that distinction. And so let's assume that there's a laundry list of other benefits. There's 401k. The employee put in $500 and you matched $500. Again, this is an expense for you. This is not an expense for you. The employee portion, okay? So the answer is, how do I see the total? The problem is, in QuickBooks, in most cases, the best way to look for it is not QuickBooks, because QuickBooks is going to put in lump sum numbers for all the 401k expense and all the insurance expense. The best way to look at it is to look at the statements you get from the vendor to break out that employee. Now, you could make sub-accounts where you have an insurance expense account for every employee, sub-account. You could have a 401k expense for every employee, sub-account. That gets it gets tedious to post in that amount of detail. I think it's better to look at your vendor statements. So whoever manages your 401k breaks it out by employee for you for the year. Insurance company breaks it out by employee for the year. I think that's better than trying to create a whole bunch of sub-accounts for everything.
Would your payroll vendor have
And your payroll would, which is another reason to do payroll. It's easier, though. Let's say that Jackie specifically wants to know, how much did I pay in 401k expense for this employee? The problem with ADP and those paychecks, if you've looked at a report, they're so complex, it's sometimes tough to pick out this number. So it's easier to go to the individual money manager or go to the insurance, look at their statement, because the payroll is just, it just goes on forever and it's hard to locate. It's in there, but it's hard to find. Okay? Let's do these because this is valuable. Let's do these. This is valuable. I'm going to do one of them just to make my point. Okay? Again, employees, we've chosen not to turn on payroll. So I go to the magic plus button. I would assume that this is closed. I hit show more. I go to journal entry. There was $200 sent in for the insurance. 100 of them was withheld for the employee and 100 of it was my expense. Okay, let's think about that. Shouldn't have put these away. So let's set aside the 401k for a minute. And let's just think about the insurance. I've got an insurance expense for $100. It's this number. Okay? So one way to do it, and again, I kind of like separating them, is to do insurance expense, cash, to handle that portion that is my expense. In other words, I could do this in one big, huge journal entry, but as I said in the course earlier, it's better to do it a piece at a time. Piece at a time. So this is one piece. Okay? The other piece is, I'm writing a check for 100 for this cash, and cash goes out the door. I'm going to need some sort of a, I'm sorry. This is going to be a payable for my 401k. I owe the money. 401k payable for that employee.
So Ken, even in this, would you do it per employee, or would you just do it based on the invoice that you got from your insurance company for all your employees?
I would do it based on the insurance for all your employees, and then if I wanted to see the detail, I would look at the detail. So let me do this. Let me do just this transaction first, okay? So I've got a payable for this employee, which we talked about before, having a liability policy to protect yourself. I'm going to say it's just insurance expense. I debit it for $100. I go down to this line. I go to my checking. And again, the number automatically fills to be 100 so that debits equal credits. And I'm going to fill in company portion insurance expense. Okay, so Renee, you said I can right click. It's awesome. I hear there's this new thing called the internet too that's become popular. I sometimes like to do that. I say, well, you can go out on the World Wide Webs and find me on the inner tubes. And people go, what? I said, I'm just kidding. Okay, insurance expense. Checking goes down to recognize the company portion of insurance expense, which is the expense. The employee withholding is not an expense. Save. Quickly. Go to reports. Profit and loss. Insurance. There's the insurance expense, $100. And finally, balance sheet. Go to checking, and you can see that we've got lots and lots of detail now in this checking, and we're going to see a decline in cash for the insurance. And here's the way, and this is why the memo is so important. It's much harder to scan and look for a dollar amount. Why not scan and look for the explanation? Okay? So if we look on there, payment for cash, salary, here it is right here. Company portion insurance expense. It's easier, I think, and this is why I want you to use memo, and I suggest it. It's easier to scan for something here than look at numbers, particularly when it's this long. So look for the date and look for the explanation. Look for the date and the explanation, okay? Any other questions?
Ken, we had one that came up earlier when you were talking about closing out at the end of the month and keeping track of everything. I know this is obviously a QuickBooks course, but we had a question from Nickel asking about what kind of actual physical paperwork you would keep in regards to the month-end billing. Do you also keep invoices in a folder by customer, or do you have folders for each month?
That's a good point. I would do both. I would keep a folder for each client, and I would keep a separate folder with all the month's activity. So you've got a folder by customer, because then it's easy to go through and flip through and see what the customer's done, if they paid late, how much business are they doing, in hard copy.
Good, thanks.
Terrific.
All right, any other questions from the audience in here?
So I would, my suggestion here is that if you keep doing this and watch the video again and try to do the T-account stuff on your own, you're going to start to gradually get more comfortable with this. The last segment of the day, and I always say the best for last, of course, is we're going to make some distinctions on the asset, liability, and equity categories and break it down a little bit further, and we'll finish the day doing more QuickBooks.
All right. Yeah, sounds like great final segment for the day. It is about time for our last 15-minute break of the day. Before we do head out, I do have a quote here that I want to read from Day2. And this is a funny quote as well. Day2 says, "Maybe I should have skipped work for this. Creative Live has been a godsend."
Well, thank you, Day2. But the great thing is that you don't necessarily have to skip work for it. We do offer anytime access to the course, and right now it is available at the live discounted price. So normally the course will be $149, but right now it's the discounted live price of $99, and then you'll also have access to the entire keynote presentation along with those PDF and bonus materials that come with enrollment.
And you won't have to miss work either.
That's right. That's right. So I'd suggest you think about that over the break. But before we go to break, we just wanted to share a little celebration that we're doing here at Creative Live. One of our very own is celebrating a birthday, David Carson. So we wanted to say a big happy birthday from all of us at Creative Live. And we'll see you back in 15 minutes.
I'm learning to tell better stories.
I'm learning how to manage 200 emails a day.
Welcome back from break. If you're just joining us, we're entering into the fourth and final segment of Day 2 with one more day to go tomorrow of small business finance basics, QuickBooks, and beyond with Ken Boyd. We had a great segment.
Yeah, we did.
This last segment. We learned a lot. This segment, we're going to be talking about assets, liabilities, equity. Yeah, and I know you're going to get further into detail, so I'm not going to try to tell everybody what you're going to teach.
Okay.
No, I'm definitely not going to try to do that. But one of the great things, and I mentioned this yesterday, that you really have a lot of experience teaching. I think you said over 1,000 hours of
I think so, yeah.
time in the classroom, which is really incredible because to have access to you all over the world, I mean, that's something that everybody's really lucky to have. And one of the other things I thought we would let everybody know, just so they know where to go to find more information about you, is the St. Louis Test Prep, and the website is STL.
STLtest.net.
That's right.
Is my site.
And what can they find when they get there?
So you'll find several things. You can split it into two groups. There are links to my two dummies books that you mentioned in the beginning of the last segment. There's links to this course. I'll have a link to this. And then I have all my YouTube videos grouped by type. So depending on what cost accounting you're looking for, you'll find cost accounting and intermediate. And they're grouped, so you don't have to go to YouTube. You can just go to my homepage.
Perfect. Well, I'll let you take this segment away and get back to you in a minute.
Okay, thank you. All right, high energy, the last segment of the day, assets, liabilities, and equity. Now, we've touched on this some already, but I'm gonna make some distinctions here, and I'm also gonna do some stuff with cash. Now that we've got some cash transactions in QuickBooks, I want to talk about cash and reconciliations a little bit. I touched on the first point at the end of the last segment, which is that, and I'm going to turn this slightly, guys. How much, Brian? Good, all right. Current versus long-term is the first bullet point there. Current versus long-term balances. Balance sheet accounts in QuickBooks, and I'm really going to try to go put a finer point on those accounts we see in the chart of accounts. Big one for this section, big. Accruals and deferrals, which relates to the matching principle that we covered earlier in the course. Posting accrual and deferral activity to QuickBooks, okay? Next slide, you'll see, again, the E equals MC squared of accounting. The assets equals liabilities plus equity. Now, I'm going to say this again because I think it's an easy way to start solidifying that formula. If you sold all your assets, you own a pizza parlor, you sold all your assets, the tables, the ovens, the chairs, everything. you had a pile of cash, and you paid off all your liabilities, the bank loan, the payables, everything, your vendors. The pile of money that's left is your equity, which is ownership. All right? Now, you will also hear people describe equity as book value, and it's not quite fit a fit, but for those of you in the audience, if you hear somebody start tossing around the term book value, assets equals liabilities plus equities on the screen. Now, in regular business parlance, you may hear this referred to as book value also. Okay? Book value instead of equity. That's not really an accounting convention. That's something that you'll hear in business generally. Okay? So I'm just going to make that point. Now let's talk about current versus long-term. I touched on it when we were in QuickBooks and we were looking at a balance sheet last time. And this has to do with how your balance sheet is organized. And we've looked at the balance sheet numerous times, so if you've been watching, some of this may start to be sinking in, and you'll start to be able to visualize what I'm going to describe. Here's a balance sheet. We have assets. At the top, right underneath assets, we always put current assets. I'm going to abbreviate. Current assets. Cash, or anything you expect to convert to cash within 1 year. What could that be? Accounts receivable. Does everybody hope to collect their accounts receivable within a year? If I don't collect my accounts receivable within a year, I'm going to be in big trouble, right? We expect to collect accounts receivable really within 90 days. Or in accounting terms, we consider it a bad debt. Receivables. How about inventory? We've mentioned that Candace has a business where she has inventory. She probably expects to sell her inventory within a year, which is why accounts receivable and inventory are both current assets. I'm going to put A/R for accounts receivable, inventory, because what I'm trying to do is to start painting a picture of what a balance sheet's going to look like. Current. Long-term asset, an asset that will not be used up or converted cash within a year. Fixed assets. Fixed assets. TM for term. Long-term. Fixed assets. So if you're a photographer and you've got a camera, or you've got a drop, that umbrella drop cloth, I think I called it, can't remember. Assets that you're going to use in your business for a year or more, we classify those as long-term assets. Okay? Long-term assets. That's the asset section. Below it is liabilities. Current liabilities, looking at the screen, it's not there. Liability or debt you expect to pay, you convert, meaning pay in cash. Convert, pay in cash within a year. Your accounts payable, you're going to pay within a year. Little tricky, the current portion of your long-term debt, meaning the portion of your debt that's due within a year. In spite of being a business person, I don't really like confrontation, and I'm not a negotiator. So, we have to replace one of the cars. My wife, business partner, the majority owner of her firm, is a guy my age who loves to negotiate. He's going to go with my wife and negotiate our car, our next car purchase, because I hate doing it. And she said, would you mind if I asked my friend to go with us? And I said, sure, knock it out. Whatever you guys, I don't care. Just tell me what color it is. I don't care. So, think about a car loan. The amount of your car loan that's due within a year is the current portion of your debt. So, current liabilities include the current portion of your long-term debt. So if I put current here, AP for accounts payable, and the current portion of your long-term debt. Long-term liability, the portion of the car loan that's due in a year or longer. Okay? Loans. LT, long-term, loan. I ran out of room. Okay? Loan. I'm going to do something if I have time. I may do some stuff on ratios today that relate to what I just talked about. It's not in my slide deck, but I'm going to see if I have time. Okay, way back, go back in the Wayback Machine. What was that cartoon where they always went in the Wayback Machine? Was Sherman? What was that cartoon? Don't remember. Somebody's remaking it into like a kid's movie. And they go back in the Wayback Machine. So way in the Wayback Machine, in an earlier segment, we talked about how to match revenue and expenses. And I say in italics, revenue should be matched with expenses that are used to incur to produce the revenue. Now, we spent time on QuickBooks today. QuickBooks, you'll see, an accounting system does not directly match these up, does it? In the balance sheet. Now, the income statement, we've got revenue for the period, expenses for the period, profit. That matches up revenue and expenses. Income statement. The balance sheet, this document, is not matching up revenue and expenses, is it? You've got to go look in the income statement to find that. Okay? Let me take that a step further. Because there's a point that I want to make. I've got an income statement. Now, bear in mind, before I forget, QuickBooks calls it profit and loss. It's the same thing. Please remember. When you go to the report section of QuickBooks, don't be panicked that you don't see the word income statement. Profit, loss. I've got some revenue. Remember the photographer that went to New Zealand and then sold the pictures in December? Keep that in mind for a minute. Let's say it's the July income statement. And the photographer has incurred travel expense to take those pictures. Say it's $1,200. But he hasn't sold the pictures yet because it's not December yet. Generally, for this course anyway, we record expenses when we incur them. That is when we write the check, generally. So he's going to record that travel expense on the July income statement even though he has no revenue yet. Okay? Now it's December. He sells the pictures from July. In December, he's already recorded this expense. So the December income statement shows revenue, but the expense has already been recorded. So the point I'm trying to make is that when you look at an income statement, it does not indicate when exactly the revenue occurred. Because we have an expense in July, we record it in July. If we have mileage expense in August, it gets expensed in August. We expense immediately. Here's why. Accountants, if you don't know already, are conservative. We have a principle called the principle of conservatism, which says, when in doubt, do the thing that creates the less profit. When in doubt, when you have to make a judgment, do the accounting that creates the less profit, which means we recognize expenses immediately and we put off recognizing revenue until we're sure we've delivered the product or service. We expense stuff immediately when we write the check. We may, however, not recognize revenue until later, okay? Recognizing revenue is probably beyond the scope of what you need to know. When you send somebody an invoice, you recognize revenue. Okay? Yes?
One, how do you handle like deposits? Or in the instance of like a nonprofit, how do you handle like restricted funds? Funds you know that have to be used for a certain purpose, but like that purpose hasn't happened yet.
Okay. I will cover customer deposits in just a minute. On your question about restricted funds, are you the nonprofit?
Yes.
Okay. Let me touch on that just briefly because that's worth mentioning. Nonprofit accounting is completely different, but it's worth spending just a minute on in case you guys get clients that are nonprofits, or if you form a nonprofit yourself, or if you do charity work for a nonprofit. This is worth mentioning. In the balance sheet of a nonprofit, the assets are called funds. So, the cash, the assets you own, receivables, and a nonprofit can have receivables. Here's the big point that Jackie O just mentioned. And then I'm going to relate it to a client I used to have. We have restricted funds. We have unrestricted funds. As Jackie O just said, those restricted funds are donated and contributed to the nonprofit for a specific purpose and have to be used for that purpose. Okay? So when I worked on TrailNet in St. Louis, shout out to TrailNet, love TrailNet, hiking and biking trails all around St. Louis, great organization. They got donations from entities, state governments, local governments, foundations, endowments, and most of them had strings attached. They were restricted funds which said you have to spend this on this bike trail, or you have to spend this on Ride Your Bike to School, which was a program they had. So, ask your question again about restricted funds.
Just about how restricted funds can be reported as far as like on that balance sheet, because you haven't used them yet, so they're not necessarily like revenue per se.
I think, Jackie O, it's beyond the scope of this class, okay. I think. But I do want to talk about it because you brought it up, restricted versus non-restricted funds, for just a minute, because it's important. Unrestricted funds can be used for any purpose. Now, nonprofits, does anybody know somebody who works for a nonprofit? I feel like sometimes I'm working for a nonprofit, even though I'm not supposed to be one. My wife, she'll be here in a while. Sometimes Ken's a nonprofit. Any purpose. Nonprofits struggle with this issue because they are struggling to get people to contribute money that is unrestricted so they can just operate and pay their bills. Most people, when they donate money, want it to be restricted for some purpose, right? So nonprofits struggle to get enough unrestricted money, so a lot of times they'll go to donors and say, at least in my experience, I know you want to name that room after your grandfather, and we can do that, and that money will be used for that purpose. But can you also donate some unrestricted funds? Because we've got to make payroll next week. Okay? Really good point, it's worth mentioning. Okay? All right. Why do we go through this matching principle thing? It's the only way to measure profit on a particular sale. Going back to the photographer, how does he know how much money he made? He matches the December revenue with the expenses that he incurred in July. It does not appear directly in his income statement. For the income statement for the whole year, it would. But if he looks at the July income statement, that has the expense. If he looks at just December, it has only the revenue and no expense. He'd have to look at the whole year to see the match. Okay? So there's timing differences here. And this is when you guys start pulling reports, this is an issue. Timing. We have mentioned in class people that are in cyclical, seasonal businesses like photography. In St. Louis, with the big variations in weather, our big wedding season is, spring, early summer. So, if you're a wedding photographer in St. Louis and you're looking at revenue, May, June, July, August, big revenue here. If you were just pulling your income statement for those months, you'd see big revenue. However, under expenses, to prepare for wedding season, you may be incurring big expenses in March and April. Big expenses in March and April. So unless you look at an income statement for the whole time period, if you only look at the revenue here, or if you only look at the months with the expense here, you're not going to see the whole picture. You see what I mean? Look for the whole period. The whole period. Cash activity for revenue and expenses may occur in different periods. And now I'm getting into this really important area. You'll remember before we talked about cash accounting versus accrual accounting. The solution to matching up your revenue and expenses is to use accounts, this is new, called accrual and deferral entries. Accrual and deferral entries. Why am I doing this? Those of you in the audience are doing this so you can match your revenue with expenses and find out what your true profit is, so that if you're in the wedding business and you have all this revenue in one period and you incur a lot of the expenses in a different period, you can put the whole thing together and match revenue and expenses. Okay? That's where we're going. My business, when I train MBAs online, almost all my tutoring now is MBA students and people preparing for the CPA exam. Between finals, the first week of December and the third week of January, that business completely dries up and goes away. Even though MBA programs now are running sometimes around the clock, they don't take a winter break. I can tell you, is like the leaves turning on the trees between December 10th and January almost 30th, there's no business. That's why this was a good time of year for me to come out to Creative Live, because my tutoring business hasn't kicked up yet. So everybody's got seasonal businesses. So now we're going to talk about how you do it. The prepaid insurance we already did, where we pay insurance premiums before the month of coverage, and we said that was an asset. I'm going to do a different one here in a minute. Prepaid is an asset because you don't have to pay the premiums later on. Let's do another one. Prepaid rent. It's an asset account because it's money you don't have to pay later. So you sign a new lease. This is usually when the prepaid rent occurs. You sign a new lease. Part of the lease requires you, how many of you had an apartment where you've had to do this, right? You got to pay a month in advance, or maybe a security deposit. Let's talk about paying a month in advance, and let's set aside security deposit for a minute. You pay $500. Can you rent an apartment in San Francisco for $500? What's the
parking space?
What's the going rate? Thank you. Parking space. We debit, we increase an asset, prepaid went. There's me with Barbara Walters again. Went. What? Cash goes down, it's an asset, it goes down by crediting. Prepaid rent asset goes up, cash asset goes down. Prepaid amounts like insurance and like rent become expenses with the passage of time. Okay? This happens, I'm going to put a date by it, on January 1st. 1/1. And we're going to say at the end of January, that prepaid rent is our rent payment for the month. So the time has gone by, and now I have to move it. Even before I look at numbers, forget numbers for a minute. If the time has gone by, shouldn't I expense it? Sure. Because the whole reason I rented the place was to have a space to run my business to make money. So as time goes by, I need to take it out of prepaid rent. I reduce the asset on January 31st, and it becomes rent expense on January 31st. Okay? Mm-hmm.
Would you do the same thing for something like gas? If you know you fill your tank up twice a month and you know that costs $200, and you're prepaying for gas before you actually drive your car and you use your car for your business?
It's theoretically that's correct. It's too difficult to keep track of. Which goes to a lot of things in accounting where if a dollar amount is small enough, we're just going to expense it when we pay it, unfortunately. Mm-hmm.
Can you explain what the advantage of doing this 1 month before as opposed to just putting it straight to the expense?
Good point. So the question is, why did we do this? Why didn't you just expense it and pay cash? I'm assuming that you're prepaying rent. You're paying rent January 1st for the month of January. So you're paying for something before you've incurred the cost, which is why I have to do this shift over here. Okay? Now, could you, in a small business, to keep it simple, just say, I'm just going to expense it? You could. You'd be a little bit off, technically, but you could. Now, a company of any size would count it as a prepaid. Okay? All right. So what I did was, what's on the screen here, I prepaid something, rent, paid cash, just like on the screen here. I recognize an expense, in this case rent expense, and I decreased the asset, the prepaid insurance. In this case, I reduced an asset, prepaid rent. Okay? That one we've seen. The next one we have not seen. And by the way, I'm going to do these in QuickBooks, but I'm going to go through the slide deck, and then I'm going to go to QuickBooks for the benefit of Ben and Brian. Okay, customer deposit. Why is it a liability? If a customer, how many of you deal with customer deposits? Mm-hmm. I suggested earlier that in order to find out if a new client is really willing to pay you, ask them for a deposit. I always ask for a deposit. It's not my ego, it's just me making sure that somebody's willing to pay me. Okay? That deposit is a liability, as you see on the screen. Why is it a liability? Because if Image, my company, doesn't provide the product or service, that deposit is owed to the customer. I got to pay them back. I get Sports Illustrated. I get it for my birthday every year, I think. And so if you send in a check for $40 for a year of Sports Illustrated, Sports Illustrated is going to record that as a deposit, and as they send you magazines every week, they're going to move that into revenue every week, and that's what we're going to see in a minute. So $50 is my deposit that's on the screen there. And this one, by the way, I believe I saw in QuickBooks as an account when we ran through the chart of accounts. This is a liability account. You know, it looks unusual, right? Unearned revenue can also be called deposits. It has the word revenue in it, and I'm confused. It's liability because you have to pay the money back if you don't deliver the product or service. Because it's a liability account, we know from the assets equal liabilities plus equity, I credit to increase a liability account. $50, I've increased a liability account by crediting. I got cash. Increase cash. When you deliver the product or service, you move the unearned revenue into revenue. So maybe it's photo revenue for image photography. $50, I reduce the liability account. $50, I move it into revenue. Debits equal credits. I've got debit, 50-50, credit, 50-50, and it balances. What did I just do? I took a customer deposit, I put it in as a liability account in red, and then I circled that when I delivered the product or service, I took it out of revenue. I took it out and I moved it to revenue. Now, let's talk about revenue recognition just really quickly. You need to have a consistent way of recognizing revenue. And it doesn't, as long as you're consistent, you're probably going to be pretty good. You might recognize revenue when you invoice a client. You might recognize revenue most commonly when you deliver your product or service, when you send them the disc with the pictures on it, when you show up with the artwork, whatever it might be. Okay? You might, if there's a risk that they're not going to pay you, you might not recognize revenue until you get the Benjamins. I love School of Rock. I got to go. Jack Black says something like, I got to go get the Benjamins. I love School of Rock. Best ever. I watched it over Christmas. We all watched it over Christmas. It was great. You might not recognize revenue until you get the coin because you think there's some risk that they're not going to pay. Now, that brings up a question. Why would you do business with a company where there's a risk that they're not going to pay? It might be a short-term thing where you've been doing business with them for 5 years and now they're in financial crisis, and you're like, yeah, you know, Joe's a good credit risk. I'm going to do business with Joe, but I'm not going to recognize the revenue until he pays me. Okay? Any questions on that one? Let's look at the screen. The first entry, we post the customer deposit, increase cash, increase a liability account. Next screen. The photos are delivered, we recognize the revenue, we reduce the liability account, and again, it now goes to a zero balance. We post it to revenue. Okay? Excuse me. I am going to switch. If Brian or Ben could just switch me to QuickBooks, that would be superb. Because I'm going to look at my notes here while they're doing that. Cool. Okay. So, excuse me. I'm going to do these entries into QuickBooks. I'm going to go back one slide. I'm going to do these, and then I'm actually going to do some others. Again, part of this is getting you used to the concepts. Part of you is just getting you used to looking at debits and credits. And part of this is just to get you used to negotiating QuickBooks. Okay? Used to negotiating QuickBooks. And what I'm going to cover lastly, I just want to see if I want to make sure it's not on my slide deck for tomorrow. Bear with me just a minute. Yeah, I'm going to do some ratios here to wrap up today because it is not on my slide deck, and I'm kind of excited that I've got time to do this because this stuff is useful. Okay, here we go. We're going to post this. This again is an accrual deferral type of entry. All right, I'm going to go into QuickBooks. I'm going to go to Home. I do not have a transaction category that really fits this over here. So I'm going to make a journal entry. I know you guys are getting weary of the journal entries, but we've got to go through them, and the repetition helps. I'm going to go to Accounts. I'm sure that QuickBooks has a prepaid account of some kind already built in to the chart of accounts. Yada, da, 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 da. Prepaid expenses. I'm going to call it prepaid expenses just to keep it simple. I'm going to debit it to increase it $500. I paid out cash, checking. It automatically fills, it gets credited. And I'm going to call it 1 month prepaid rent. I'm going to copy the explanation down, copy, paste. By the way, I paid in 1985 $3,000 for a Mac computer. Had a printer too. $3,000. 1986, paid $3,000. Isn't that amazing? How far we've come. Prepaid expense. So now I'm going to do that as one journal entry. And we're doing it, I'm going to do it as of January 1st, beginning of the month. So I've changed my date. Be careful on your dates in QuickBooks. And I'm going to hit Save, and the journal entry saved. Now, again, tricky with dates. I get to the end of January. I am going to recognize insurance expense. I know my expense categories are at the bottom as I scroll. I'm looking for I. There's insurance expense. Now, even though it says insurance, it is an expense account. And it's going to, and when you go into the detail, you'll see that it says expense. And I'm recognizing an expense of $500, debit to increase in expense.
I think there was a category under.
Was there? Cool.
Oh, interest expense. Never mind.
Oh, it was interest? Okay.
Well, no, what's insurance liability and disability?
Oh, we're doing rent.
What are those?
We're doing rent expense on this one. We're not doing insurance. I misspoke. We're doing rent. So here's a category that is rent or lease, and it is an expense account. Rent or lease, expense. I am now going to reduce that prepaid account. So I have to go up, and there's my prepaid expenses, and it's reduced by $500. Okay? Now, I'm going to make sure I did these right. Oh, no, I'm going to say, I need an explanation, and I'm going to say to record insurance expense. And this is nice to connect these so you can follow what's happened. Prepaid on 1-1. Rent. I'm stuck on insurance. Thank you. Prepaid rent to record rent expense that was prepaid on 1-1. So that is enough where if I went back into QuickBooks, I could remember what happened. Okay? Now, I just want to check and see if I did these journal entries correctly. So I go to Home, I go to this clock, and I'm going to look at recent transactions. There's the prepaid expense for the rent, debit to increase an asset, credit checking to reduce it, So that one looks okay. Journal entry 12, save. I X out of journal entries. I want to look at the other transaction too. I go to the clock. 12, prepaid. Oh, I went backwards, sorry. So that we have prepaid and checking, that's transaction 12. Clock, 13. There's the expense and reducing the prepaid, okay? So what we just did was we recorded a prepaid expense and cash going out the door in QuickBooks in one journal entry. We recorded reducing the prepaid and expensing it in the second entry. Okay? As I mentioned, it's very likely that QuickBooks is going to give you a customer deposit account. Here we go. Plus, let's say this is smaller, show more, journal entry. I know we're almost done with journal entries for the day, if you can just hang in there. Okay. We get cash in the door. We increase an asset by debiting. $50. Customer deposit. I know it's a liability account. I wonder if there's one already built in QuickBooks. I look at my chart of accounts. Excuse me. Unearned revenue, customer deposits. It's already in there. Credit $50. To record now let's say it this way, customer deposit. Make it easy. I copy the memo, I copy it down to the next line. Okay? Last entry, I need to reduce the one I circled. I need to debit unearned revenue to get rid of it, bring the balance to 0, and I need to recognize photo revenue. Okay? Unearned revenue customer deposit, I'm going to debit to reduce it, $50. I'm going to recognize, now I can move it in the revenue because I've delivered the photos, I've delivered the product or service. Okay? Yes, Renee, just let me record this and then I'll take your question, I'm sorry. I'm just going to record it under sales. Now, I'm going to need an explanation, and the explanation is provided photos to customer, deposit now revenue. And I'm going to copy that down. Copy, paste. Yes, Renee, I'm sorry.
Okay. Would it be helpful to notate what customer it was?
Absolutely. Thank you. I would know what customer it was. Mm-hmm. And now the question is, let's say you get 5 customer deposits. What do I do in QuickBooks to make that distinction? I would not make a separate account for each customer deposit, but I would mention their name in your memo. That's a very good point. Okay? Let me do one on payroll. My daughter works at a pizza place in Dayton, Ohio called Dewey's. She works at Dewey's Pizza. That's not out here, is it? It's only Midwest. It was founded by a guy whose dad owns the St. Louis Cardinals. The DeWitt family owns the St. Louis Cardinals now. We're very big on baseball. This is a payroll accrual, and I don't have it in my deck, And I've done enough journal entries, so I'm not going to do it in QuickBooks because I think you're going to get the idea. I could, but I think it's going to get a little repetitive. All right, payroll accrual. Here's the issue. All of you out there are going to have this issue if you're paying people. All right? Here's the issue. The expense belongs in one period. But the check is written in a later period. We've all done this. You guys all know this. Cash moves later. So it's the last week of the year. And you have employees who you owe $700 to for the period from December 27th, my wedding anniversary, to December 31st. I'm told it was the happiest day of my life. Ask around. I owe them that money, but I'm not paying them until January 5th of next year. But I need to make an entry on 12/31. Why? I need to get the expense in before the end of the year because they worked that time before the end of the year. The expense belongs before the end of the year. And the question is, what do I do? I got to record an expense. It doesn't really matter what the numbers are. I know I've got to record an expense. And after I get through this one, I'm going to ask the group a question on a different subject, if I can help me remember that. I got to record an expense, $700, but I haven't paid him the money. Do I owe him the money? Is that a liability? Yeah. Now, the title of the account you put it in could be accrued payroll, accrual for payroll, accrued liability. The point is, this is a liability account because you owe them the money. Okay? That's the entry that I make at 12/31 to make sure that I get that expense in the right year. Debit to increase in expense. January 5th, which I think was my grandmother's birthday. There's some significance to that. I always wake up in the morning, I think what day it is, and think of that if that has any significance to me. I think that was it's my grandmother's birthday. I knew there was a reason. So now I'm going to pay the payroll. I am going to debit this account to get rid of it, and that balance is going to go to zero. I'm sorry to write so low for the people who are watching. I know that's kind of low on the screen. I'm then going to pay cash of $700. So what's happened is I have the expense before the end of the year. I have the cash being paid in January, and now this account has been adjusted to zero. All right? Any questions on that? Let me switch gears here because there's something I want to cover the rest of the day. Yes, Jackie.
Just going back to that previous, when you're making your entry for 12/31, even though you know you're not going to actually pay till 1/5, when you're closing out 12/31, how does that work?
Ooh, that's a good question. Great question. When you close out for the year, that expense will reduce your profit for this year, absolutely. And it should, because the work happened before the end of the year. Good question, yes. Anything else?
So it doesn't get resolved until the next year, though? It goes on to the next year's books.
The expense is posted and done with, but the payment does not occur until next year. So I assume everybody now is going to run out and start a payroll company, because that's kind of the vibe I'm getting. Man, I can't wait to get out of here and start a payroll company. Awesome. All right? What What would be, so let me just throw out this general, I'm switching gears. General question. Here's a question. Question. What would you like to know to plan your business going forward? In other words, what concerns you? What is an issue financially going forward? And if you can think of some, and then I'll throw some out. I mean, very generically. We've been beating up QuickBooks pretty good this afternoon. What concerns you about your business going forward? And Brian or Ben, if I could move to just the main screen of the course, that'd be great. Thank you. What concerns you? I'm going to throw out one if I don't get one. You're trying to plan for the future.
Well, if you're thinking about buying a machine that might increase productivity, how much profit would that bring?
Perfect. And we're going to cover that one at the end of the day tomorrow, which is making a decision about spending a lot of money on an asset. So that's a good one. What I'm going to finish up today doing, and I'm glad that I was able to get to it, are ratios, which are just simple tools. They're not in my bonus material. These are in addition because I wasn't sure if I was going to get this far. Ratios. Now, what these are tools that you can use to keep on track in your business. Tools that you can use to keep on track in your business, okay?
We had a couple answers to that question that you
Oh,
posed
good.
come in. And Jesse L. said staying on top of cash flow is critical. And Jester agreed with Jesse L. and then said also long-term profitability.
Perfect. That's the perfect setup. Cash flow is segment 10 tomorrow. Long-term profitability. Let me take off on that point. Two terms. One of them is liquidity. Now again, I'm introducing some kind of, jargony accounting here, but there's a point. So liquidity is, do I have money, cash flow to pay my bills and cash flow myself over the next year? That's liquidity. Am I got enough cash coming in the door to make it 6 months, 9 months, a year? As opposed to the person on the chat, which is long-term, is called solvency. Solvency. Are you solvent? Okay? Let's talk about liquidity first. And this relates to what we're going to talk about in cash flow tomorrow. All right? Liquidity. One ratio is, I'm going to abbreviate, current assets divided by current liabilities. Now, I'm not asking you to be a math major, but this is going to make sense here in a minute. Brian, is it possible if I could get another blue marker? I've worn one out. Oh, you know what? Never mind. I'll use this. I'm going to walk this way. Okay, I'll use this. Again, liquidity, which is what I'm talking about now, I'm going to get rid of solvency, is do you have the ability to collect cash and pay your bills in the next 12 months, okay? Current assets divided by current liabilities is one way to look at it. What were some of the current assets that we covered today? One is cash. What else?
Assets you expect to convert to cash.
Perfect. You get a smiley face for the day and a gold star.
Excellent.
We have them right outside the door. Well, I gave it away. We weren't going to tell you, but you're the winner. Cash, accounts receivable, you expect to convert to cash within a year. Inventory, you expect to convert to cash within a year. Okay? That's the numerator. That's the top. Those are the current assets. Current liabilities, accounts payable, mostly. The current portion of your long-term debt. That's the denominator. I had a very mean trigonometry teacher in sophomore year in high school. She looked like the Wicked Witch of the West from Wizard of Oz. She was not a nice person. She made trigonometry difficult. I mean, I'm probably on a scale of 1 to 10. I'm maybe like a 6.5 or a 7 on math. I'm not really good at it. Here's the point. You have to have enough assets coming in the next 12 months that you're going to convert to cash to pay all of these. Do you agree with that? The numerator has to be as big as the denominator or you're in trouble. For example, Brian, I'm going to pick on you one more time. Can I get some more water, please? Sorry. If you have $100,000 in current assets, but you have $150,000 in current liabilities, can we agree that you're going to have to go out and get $50,000 somewhere? Thank you. What are the 2 ways you can use to raise money to run your business? As a review. If you get this one, you get a fruit basket today. Pardon me? You're right. Which would be equity or, what was the other one? Which is also debt or equity, right? My point is this. You've got a $50,000 difference here. You're going to have to go out and get $50,000 somewhere. That means you borrow it, which is debt, or you sell ownership in your business. And this is the crisis that occurs when people have to sell ownership in their business under duress. Big thing for business owners. Why did you go out and get an investor? I did not have enough cash flow to get through the next year. Okay? Which is why, and I think several people have touched on it, and I think Jackie O and Josh in particular, I think everybody has, that we're cautious with expanding, right? We're cautious. Why? We don't want to get in this mess. Okay? We don't want to get in this fix. Now, I can adjust this problem a little bit. We're still talking about liquidity. So current assets over current liabilities, CA over CL, is called the current ratio. And by the way, QuickBooks can calculate these in their system for you, which is nice. We can amend this a little bit. Here's what you may change. You may leave out inventory in the numerator. Remember this had inventory in the numerator? Because inventory is a current asset. You may want to leave that out because between receivables and inventory, I don't know about Candace, but maybe you hang on to your inventory for 9 months, close to a year, depending on your business. Okay? So you may say to yourself, I don't want to include inventory as the cash coming in over the next 12 months because I think it's a little tight on whether I'm going to sell my inventory or not. So you're not going to include inventory in the numerator. That's called the quick ratio. Again, why am I telling you this? These are just tools for you to take a look at your business and see where you're headed. Because if you are getting to the point where your liabilities are getting current liabilities are getting a lot bigger than your current assets, you need to make some changes. You need to get another investor. You need to get more financing. You need to do something. Okay? Do something.
Are there some ratios that, if you're trying to compare and see what your ratio actually means, that may be industry specific?
Yes. Thank you. I would highly recommend you go out on the web and look for these ratios for your industry. And a good way to find it is if you go out and look at financial websites where you have financial analysis, they can show you these ratios. Or if there's a company that's a public company that's similar to what you do, I mean not similar in size, but similar in business, if you look at their annual report online, they're going to have all these statistics, and then they're going to have all the statistics for the industry. For example, I did a blog, I also blog, and it's attached to my website, when Men's Warehouse Joseph A. Bank made a bid to buy Men's Warehouse. And Men's Warehouse put out an extensive PowerPoint on exactly why they thought that this buyout was a bad idea for their shareholders. And one of the things they put in was they compared all their ratios with all of Joseph A. Bank's ratios, and they said, look how much better off we are. Here are 16 bullet points on why we're better off looking at these ratios. Okay? That's why these ratios are important. That is a liquidity ratio. Liquidity, can you pay your bills over the next 12 months? Let me do a solvency ratio. I mentioned for the fruit basket that there's two ways to raise money to run your business. There's debt and there's equity, right? Very simple ratio is looking at your debt in comparison with your equity. So if you have taken out a $100,000 bank loan and you have sold $300,000 worth of stock, that's a 1/3 ratio. Now, is that good or bad? Well, it depends on your industry, really. But I will tell you this. Another red flag is when the debt number on the top starts creeping up and becoming much bigger in comparison with the equity number on the bottom. Okay? When the debt number on the top starts getting bigger than the equity number. Now, let me talk about industries. Some industries can carry a lot of debt. How many of you pay your utility bill? Yeah. They got pretty good cash flow, don't they? And earnings. A friend of mine, I mentioned, is the CFO of the utility company for Kansas City. I drove by Pacific Gas and Electric this morning when the guy took me to this office very quickly. I got here in a hurry. I was saying a rosary for people on bicycles. This guy, wow. I walk out of my hotel and I don't see him, and all of a sudden he's parked across the street. And he just, it's like some out of a cartoon. I got here in a hurry. A utility company can carry a lot of debt. Why? They've got reliable earnings. They've got reliable cash flow to pay off debt. Utility company can carry a lot of debt. Most of the people in this audience are in businesses where your profit is less certain, and also in businesses where there's the possibility for huge success down the road. Microsoft. You'll love this. I love this. Maybe you won't. I was sitting in a class senior year of college. That was a capstone class. It was supposed to be the culmination of your business school education. Spring of 1985. I had a professor tell me in 1985, it's kind of a bummer you guys are coming out of college when you did, because you know all the technology that's going to be invented is pretty much already in place. 1985. Microsoft became a public corporation in 1985. They've done all right. Can you believe a guy said that? Yeah, you guys are really coming out of college at a bad time. I'll never forget the guy saying that. So many of you are in businesses where the upside is monstrous because of technology innovation. Microsoft, as an example, until recent years, never had any debt. They didn't need to. Why? People were buying the equity and the stock price was going up. They could issue more and more equity because they were performing and the company performed. Earnings went up, sales went up, stock price went up. They never had to take on any debt. Also, Microsoft for years never paid any dividends to reward shareholders. Why? The stock price kept going up. They didn't have to pay a dividend. People didn't demand a dividend. Finally, they got so much cash, like Apple, they started paying dividends because their growth slowed down. And so they wanted to reward shareholders. The growth of the stock price goes down. You know, we're sitting on $1 gazillion of cash. We'll pay people a dividend. So depending on your industry, you may have a lot of debt or a lot of equity or some mix. All right? But even in your own little world, as you move along, if this debt number is starting to creep up and not the equity, that might be a warning signal to you. In terms of selling equity in your business, a friend of mine says, you know, I'd rather own 1% of a $100 million company than 100% of a $1 million company. So when you're selling off ownership in your business, consider that. Being a really small owner of a gigantic company, that might be a pretty good thing. If that's what you want to do. Now, not everybody wants to grow like that. Any questions on liquidity and solvency? Okay. Candace carries inventory in her business. Let's talk about ratios related to inventory.
Is the debt over equity ratio related to the solvency?
That is solvency because that has to do with the long-term success of your business.
Okay.
Specifically, if you just keep taking on more and more and more debt, you're going to have a problem. Inventory. We have a cycle, don't we? An operating cycle for every business. As a friend of mine says, get the cash and don't get sued. What a great, you know, we could monogram that on a pillow and put it in our office. Get the cash and don't get sued. That's pretty good advice. So we spend money on a product or service. We deliver a product or service, which might be inventory. We collect cash. We use the cash to spending, and it keeps going, right? You ever noticed, does anybody go to Walmart? You guys don't really have them in Metro San Francisco. Or Target. We're Target people. I found families are either Target people or Walmart people. I was in Target 1 hour before the St. Louis Rams were in the Super Bowl. 1 hour before the start of the game in the city where the team's in the Super Bowl, mobbed. Walmart was mobbed. I never go there, but they had something I had to get because they didn't have it at Target. An hour before the Super Bowl starts. Mobbed. Could not believe it. I use Walmart as an example about this system. People like Candace are spending money to buy inventory, and they're out of pocket that money until they deliver the product or service and they get paid. So there's a time gap here. Walmart, I know several people kind of on the periphery of servicing Walmart, and one person who is a friend of a friend is a Procter & Gamble rep that is responsible for getting Tide soap and Ivory soap, two Procter & Gamble products, into Walmart stores. She lives in Bentonville, Arkansas, where Walmart's headquartered, northwest Arkansas. Walmart has such clout that they insist that vendors like Procter & Gamble deliver product and stock the shelves every day. In other words, the only inventory that Walmart carries is what you see on the shelves. There's no back room with extra inventory. It's all in the store. Okay? They have virtually no cycle. Their cycle's so short because they're not keeping much inventory at all. So if there's 50 bars of Tide soap, they sell 40 of them the same day, and then Procter & Gamble comes back in and stocks the shelves, and it doesn't cost Walmart anything. Now, we're not in that instance, but it's a good example of this cycle. So the ratio I'm going to show you is a way of tracking this cycle. Okay? Looking at your inventory over your cost of sales. Inventory divided by cost of sales. Okay? So let's say that in a year, Candace has cost of sales of $1 million. And on average, this should say average inventory, the average during the year, on average, she's got $100,000 sitting on the shelves. Okay? What that means is she is selling all of her inventory out, and rebuying it again 10 times in the year, right? She's buying all the inventory. She's selling all the inventory and buying it all again 10 times in a year. Now, you could look at it as cost of sales over inventory, cost goods sold over inventory. You could flip the ratio to make it 10 over 1. You can do that. It's not real important. The point is you're comparing these two. Here's the goal. The goal is to sell as much as you can, cost of sales, and minimize the inventory you have to keep. This is the magic of Walmart. Their cost of sales is $1 gazillion, and their inventory cost is nil. Why do we care? Because the lower you keep your inventory, the less money you have tied up in inventory. And the faster you sell, the faster the circle goes and you collect cash. See what I mean? We want to minimize our inventory, and we want to maximize our cost of sales. So I mentioned my wife's boss is going to help us buy a car. Has anybody bought a car lately? So if you look at a car lot, and I didn't know this until I worked with a car dealer, I always used to think, man, can you imagine the hundreds of thousands of dollars, millions they have tied up in a car lot? Those guys are turning those cars really fast. If you visualize it, big car dealerships are selling 200 to 300 cars a month. All the cars you see on the inventory when you drive by, they are not there next month. They are turning those cars over. Turning them. So, they've got a big investment in inventory, but if they sell all the inventory every month, and they do that 12 months out of the year, their cost of sales is pretty big compared with their inventory. So what we just did is explain how if you can maximize your sales and minimize your inventory, you can get that cash collected faster, and you don't have to buy as much inventory, which ties up your cash. Okay? Two assets tie up most of your cash. That's inventory. What was the other one for the fruit basket today? What other asset ties up the most cash besides inventory? Pardon me?
Equipment?
It could be, but the one I was getting at was receivables. Let's talk about receivables. Big risk, I'll discuss it tomorrow again in cash. If you increase sales, but your average collection slows down. Okay? This is why, and this whole issue, this is why with inventory and receivables paying online, it's just speeded this up. Okay? Everybody can pay faster. You don't have to have as much inventory if people pay on average within 2 days rather than a week. Mail in a check. It speeds everything up. It's fantastic. Here, an example. Let's say it's June. And you have $100,000 in sales. And on average, it takes you 30 days to collect the money. That would indicate that after 30 days, you've got the $100,000 back in your pocket. You've turned the cycle and it's back in your pocket. Okay? You increase sales. July, 130,000. That's good. But on average, because you added new clients who pay slower, it takes you 45 days on average to collect the money. After 30 days, do you have this whole 130,000 back? No, because it takes 45 days on average. Some of this has not been collected. If you increase sales again to 150,000, where are you going to get the money to pay for these sales and spend the money and do the prep and buy the inventory if you haven't collected all this yet? How can you increase your sales if you haven't collected all this yet? Because again, it's going to take 45 days, which means it's bleeding into this next month by 15 days. So here's the problem. If you're going to increase sales, you've got to consider who you're increasing sales to, and are they going to pay you at the same rate? Because if they don't, you're going to get into a cash bind. Particularly if you're growing, you need even more money to develop these sales than you do here, and even more money here than you do here. You see what I'm saying? The trend? If sales are going up, your costs are going up. And if you're slowing down the dollar collections, you can't pay the costs, and you're stuck having to go out and get more financing again. Okay? That okay? That's a big one. For this audience, where you guys can go out and bill and do stuff on a low-cost basis right away, collecting is everything. Okay? Going back to a point that I made earlier, I would be judicious and careful about discounting. Couple reasons. First of all, you guys deserve to get paid for what you do. You know what? And I have, in restaurants, I married a waitress. My wife waitressed for years. I'm a big tipper. I know that's hard work. I'm willing to pay people for their expertise. And I feel, and because I'm in that same boat. But more importantly, when it relates to this, if you discount, you're cutting the cash flow. And if you're cutting the cash coming in, you're cutting your ability to grow your business the next month. So I would be careful about discounting. I mean, I'm 51, I just tell people no. No, I'm sorry, do you discount? No. How about those Cardinals? You know, I don't have any hesitation, I just tell people no. Because I value what I do, and I'm willing to let that business walk away, because I don't want to jack around with trying to collect money that's going to screw up my cash flow later. Now, you may have a different view, and that's cool. Okay? So, this is receivables, speeding up collection of receivables. Speeding up collection of inventory. Do you see the pattern? Inventory and receivables. Get it out the door and get the money in. Get the inventory out the door and get the money in. Get the money in from the sale. Get the money in from the sale. Going back, a couple more. I'm glad I got to ratios. You may be bored out of your tree, but I'm glad I got to. Solvency, don't let that debt number creep way up compared to the equity, particularly if you're in a company where your profit is uncertain and you know you're not, it's hard to make the debt payment. Don't take on more debt. This one, make sure that this ratio is at least 1-to-1, that you've got $1 of current assets to pay that current liability. Okay? Questions? That's a lot. That's ratios.
We actually had a question come in, and we'd normally handle this at the end of the day, but I think that everybody out there is anticipating tomorrow as well, and we actually had a question come in asking what we're going to go over for each segment tomorrow. Could we talk about that for just a bit?
So segment 9 is income, expenses, and generating a profit, where I go into some detail on several questions that are on the bonus material, in fact, several formulas, I should say. Break-even formula, and including your income goal in a formula to figure out how you can reach your income level. So that's segment 9. Segment 10 is my cash flow, where I go into more detail than what I just did on the board. Optimizing cash flow is segment 10. The reports you can get out of QuickBooks. I'm going to cover some of that in segment 11, transactions using reports. And finally, segment 12, if you look at the title of any accounting book, it usually has the word decision or decision making in it. Because the goal of why am I here? That's very existential, isn't it? Why am I here? Because this is all designed to help you guys make better decisions. That's all this is here for. And this was about decision making. I'm going to give you 4 decision tools in the final segment tomorrow to make better business decisions, and I'm going to be able to throw in some other stuff that I didn't plan on ratio tools. So that's tomorrow.
Well, if we don't have any questions here in the studio, looks like everybody's solid. I think it is about that time for us to wrap up for the day. And thank you for going over what we have coming up tomorrow. We also wanted to share with you some of the comments that we had coming in. This was a little bit earlier in the segment, but we didn't want to leave you hanging. Somebody actually did go into the chat room and answer a question that you had about the cartoon. Twister Dodger 4 said it was Fractured Fairy Tales with Peabody and Sherman, and it was the way back episodes where Peabody's Improbable History. So
there you
got
go.
your
Yes,
answer.
thank you.
And Sweet D said, please tell Ken that I am not weary of the journal entries. I'm loving them. And my accountant is going to love me this year when I give him a QuickBooks file instead of my usual shoebox full of papers. Thank you, Ken and Creative Live.
Great. Right on. Yeah, that is great. And it is the end of day 2 already.
Amazing.
We do have one day in the books tomorrow, but I think right now at the end of day 2, we should give a great thanks to Ken and to all of our studio audience here for a wonderful day, and everyone behind the scenes who made day 2 possible. Let's do a quick round of applause for Ken. And today in this final segment, we talked a lot about equity and expenses and investments. Just to recap, we learned today some good things to invest in, a payroll system to make your life a lot easier. You also want to invest in a good accountant, especially around tax time. And I'm going to add another one to the list. After watching this, you may want to invest in purchasing this course. Because, there's a lot of information there that you're going to want to refer back to. And as we've been talking about all day, this course normally does sell for $149. You can still get it while we're live on the air for $99, which ends up being a fantastic investment in your business. And of course, if you were to purchase it, you would add that into QuickBooks, right?
Yep.
Keep track of all of the expenses in there. But I think that could be a great way to take the next step with your business, and you'll be able to refer back to all the slides we've talked about today, everything that's been in the keynote, as well as all the diagrams Ken's been drawing up on the whiteboard over there. So you'll be able to pause, rewind, see everything we've been talking about. If there's anything unclear, you can definitely clear it up that way. So also, I do want to remember, everybody, don't forget that if you have been enjoying this course, and if you do want to support Creative Live, the best way to do that is to vote for us in the Crunchies Awards that we've been promoting for the past couple of days. It's very easy to do. We'll have the URL on the screen. And also, we did check on the deadline for that. Voting does close on January 26th.
That's right.
So only a few days there to check it out. So please do go. It only takes a second, and we really do appreciate it.
Yep, and we were nominated for Best Educational Startup. And if you're not sure what the Crunchies are, just to clarify, it's an annual award done by TechCrunch, which is a great honor just in and of itself to be nominated.
Yeah, it's a really great honor. This is the 6th annual Crunchies Award, and they do it right here in San Francisco. So it would be great to make a scene there and try to win this as a local award. It would be great. So we would appreciate you if you did vote. So now's the time to do it as we wrap up day 2. Take the time, go vote, and we will be back here at the same time, 9 a.m. Pacific tomorrow morning. Hope to see everyone there.